It's been an incredible first half of the year with respect to the equity capital markets.
It's not just one narrow group of companies and everything else is lackluster. It's really broad.
I think you want to be really thoughtful about the positioning that you have.
You want to avoid places that have not had good earnings momentum.
We think that this has legs.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, the sell-off deepens. The once high-flying chip stocks on the brink of a bear market as Netflix quarterly earnings are falling short of expectations. SpaceX is sliding after scrubbing its latest launch attempt, trading lower following engine failure.
So everyone's trying to understand what is the latest catalyst when it comes to what is happening in the technology space. And potentially, it's coming this morning from Beijing. This new Kimmy moment, as investors are calling it, sort of like deja vu to the DeepSeek moment. We are seeing a model out of China that people are saying rival those of Anthropic and OpenAI.
Kimmy moment, DeepSeek Volume 2, another China shock. We're responding to that this morning, and already we were seeing weakness in the tech trade, and that's the problem. We got weakness in the chip trade. The once high-flying chip names that were up by something like 90% in Q2, down aggressively on the brink of a bear market. This is another knock to sentiment at a pretty fragile time.
Right, pick your poison in terms of what you think the actual catalyst is. Jim Reed over at Deutsche Bank this morning talking about TSMC. They had great numbers, absolutely blockbuster numbers, but they raised their 2026 CapEx forecast to 60 to 64 billion. That's up from prior guidance. Are they having to spend more? And is it going to be there in terms of, is this real AI trade and the hyperscaler build out actually real?
And not just TSMC, earlier this week, ASML. Numbers have been really decent so far this week. This started a few weeks ago. Samsung came out, fantastic results, traded lower. How the market's responding to the information right now tells you a lot about positioning and price. We'll be talking about the latest out of China in just a moment from Aaron Kennon. I want to talk about the latest as well in the crude market. Commodities elevated this morning, Brent up by close to 2%, 85, north of that approaching 86, WTI around 80. 6 consecutive days of strikes by the US on Iran. The strikes in the last 24 hours different. The scope has started to broaden, to widen. This is something we haven't seen so far this week.
They are broadening, and if you look at reports coming out of the likes of the Wall Street Journal, the Associated Press, they're expanding. Multiple bridges were hit in Iran yesterday. This is an effort to really cut off potentially the supply links that the IRGC uses, and the AP says they've expanded as well this morning. So the latest we heard from CENTCOM was last night, 9:40 p.m. They said that was the 6th night of strikes. And they're continuing again this morning. And also, vessels going through the Strait of Hormuz. If you're an Iranian vessel, beware. We are seeing an incredibly aggressive U.S. blockade.
We had some decent data earlier this week. Softer CPI, softer PPI. How much comfort can you take from that when we've just seen a bounce back in crude higher on the week by more than 10%? Coming up this hour, we'll catch up with Aaron Kennon of Clear Harbor Asset Management with chip stocks on the brink of a bear market. Tobin Marcus of Wolfe Research as the US strikes Iran for a 6th straight day. And Alicia Reese of Wedbush as Netflix fails to impress. We begin this hour with stocks extending tech-led declines. Aaron Kennon of Clear Harbor Asset Management writing leadership is steadily expanding beyond semiconductor manufacturers towards the broader AI ecosystem. Aaron joins us now for more. Aaron, we've got to talk about the latest out of China. Moonshot's new Kimmy K3 model. Maybe a lot of people aren't familiar with what's coming out of China. They're telling us, as they might, that this can rival the models coming out of Anthropic and OpenAI. Aaron, do you see this as another DeepSeek type moment, or is this different?
Sure, feels that way, Jonathan. Clearly it's a question around, how competitive is this Kimmy 3 model relative to the closed source models that we have here in the United States, made by Anthropic, OpenAI, Grok, and others. It also questions, how much CapEx have we spent this year across the hyperscalers? What will be spent next year? Could we see the slope change as perhaps the return on invested capital question comes into the fore? I mean, the other question that I think is worth pondering too is Kimmy's made a model that's competitive with U.S. models, and they do not have the leading chips that are designed here in the United States by the likes of NVIDIA, like the Blackwell chip or the Rubin chip. And so that would suggest that perhaps they're creating more output, more intelligence per unit of compute power with perhaps an inferior chip. And that could be very disruptive to the semiconductor ecosystem. I'm just postulating here that there's a risk to that.
I would just say, Aaron, in response, we've got no idea. I've personally got no idea how compliant they have been with export controls, but certainly raises questions about the kind of access they do have, the kind of developments they're making right now with the chips they have locally, domestically. That raises a lot of concerns, and here's one. You mentioned it. Are we getting to a position where it's harder and harder to justify the amount of money that the hyperscalers here in America have been spending, and start to question the wealth transfer we've seen from them to the chip players over the last 12 months? Is that trade becoming more and more vulnerable?
Yeah, I think it feeds into a broader question around are we going to see some sort of level of regulation within the AI ecosystem, both in the United States and perhaps globally? And there's been a discussion about that this week in the marketplace as well. And how does open source versus closed sort of function under that regime? I would just say, as it relates to the return on invested capital question that you just posed, it's a real question. But the likes of Alphabet, OpenAI, Grok, and others, they are playing the long game, and so I suspect that they're not huddling up this morning, altering their capex estimates for the coming months.
When it comes to technology space, we also have Google potentially behind on their Gemini model. You have SpaceX overnight. What do you think the next catalyst is going to be?
Well, Annmarie, it's been a stunning week. For mid-July, we have geopolitics, the Strait of Hormuz, the escalation that you just reported on. We have earnings, which have been coming out fast and furious. Bank earnings have been very strong, a little mixed on the other side, but 20+% annualized growth rate in the second quarter. These are the types of growth rates we tend to see coming out of a deep recession. So it's not all glass half empty for sure. And of course, we have Fed Warsh in play with the Fed, and it's been quite a week.
So do you think this isn't even so much chip specific when it comes to the sell-off, but other factors like what's going on in the conflict in the Middle East?
Yeah, I think it's a healthy breather. The semiconductor trade has been a volatile one. The equity trade through just a week or so ago was heavily momentum driven. The momentum factors come off. Kimmy just was released yesterday, and so we're seeing increased volatility again this morning. I want to be a little careful that the narrative of the last 12 hours around Kimmy, it is akin to sort of the DeepSeek moment. But I think it does raise some very important questions about how the AI build out, how that ecosystem evolves. What are the efficiencies that are going to be brought perhaps by the open source models from China? And how does that impact the demand for things like memory, which is all of the rage right now, with the likes of SK Hynix just having come with their ADR, and of course Micron and SanDisk and others in that space. And so it'll be interesting to see how this all evolves.
If you strip down the muscle of big tech, just looking at the index, go to the equal weight, and we closed at an all-time high just yesterday. The banks, not just the big ones, some of the regional players as well, Citizens, Fifth Third, PNC, take your pick, closed at records just yesterday, and we saw the big players on Wall Street deliver record highs as well. I just wonder, from your perspective, if we do have this fragile moment in tech, how isolated it will be, and whether it will really start to unravel the other part of the market as well that's doing quite well and holding up in the meantime.
That's right. I mean, yesterday the equal weight, I believe, was actually positive, and market cap weight was negative. We have now the equal weight up about 250 basis points year to date, in excess of the S&P market cap weighted index. And so, you look at all the sectors, all the 12 sectors, I think only one is down year to date. And so it suggests that there is a broadening, but we have to be a little careful to deduce too much. The relationship of the sectors within the AI ecosystem across industrials, technology, within technology, semiconductors. As semis go up, it seems like software goes down. That's been an inverse trade year to date. And of course, banks, they're seeing increased activity on trading, but they're also seeing increased activity as it pertains to the AI build out in M&A. And so we have to keep a close watch on the correlation across sectors. But, growth looks strong. I think 5% nominal is possible this year. Inflation is decelerating out on the core side of things, and that'll be a focus for the next several months.
To your point, Aaron, it all feels like one trade. and that's the problem. Can you help us navigate that? This note just dropped from Jonathan Krinsky of BTIG. He sits in a different seat. He focuses on the technicals. He said there's a risk of a high correlation accident and that the risks continue to grow. Do you think it's avoidable?
I think it's avoidable if you don't just own the market, right? If you own the market, then you have 20% in the semiconductors in the United States. You have 25% in EM. And so if you own semis, you also are correlated to all the other aspects that we just discussed. So as an asset allocator, even within equities, I think there are other places to move. The banking sector looks strong. It's not just the semi trade, obviously. There's a lot of M&A, regulatory environment's positive for the banking sector, trading activities up, wealth activities up. We know that's related to AUM. And so, we think that there are opportunities across the landscape, but there's a lot of correlation going on, even down to utilities, as we know, as it pertains to this AI trade.
It's all felt like one trade. Without a doubt. Aaron, thank you. Appreciate it. Aaron Kennon there of Clear Harbor Asset Management. If you're just joining us, the S&P 500 negative, the NASDAQ underperforming. We're going to be spending the whole morning. You're going to hear this a lot. People are going to be talking about the Chinese AI startup Moonshot and its new model, Kimi K3.
A new surprise at this AI conference as well, where Xi Jinping spoke, really talking about taking on the dominance when it comes to the AI trade. And according to the company, they think this rivals the United States' top models when it comes to Anthropic and OpenAI. And that's why people are a little bit concerned. And interesting point there you brought up with Aaron about, are they really export compliant? How are they making these models?
We don't know. The president has been talking about election interference with regards to China. Let the president say what he's got to say, and we'll let the experts talk about that if they want. I would just say this, from the perspective of the economy and the perspective of financial markets here in the United States, the greatest threat to them right now, one of them, is developments on tech in China. Never mind election interference. These kind of things could upend this market. And in some ways, given the amount of money that's being spent and how dependent this economy has been on all of that spending, it could upend this economy too.
Absolutely. That's only also one key to the puzzle. There's also the geopolitical key to this entire trade, which is the fact that we are so reliant on Taiwan, 90% when it comes to chips that are fueling this entire hyperscaler demand, AI build out in the United States. And there has been a growing threat on that island.
We've had moments like this before. We worked through DeepSeek and then people just stopped talking about it. Yeah. And we'll see if this is one of those moments or if it's slightly different. Equity futures on the S&P, we're down by 0.9. On the NASDAQ, we're down hard. With an update on stories worldwide with your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. The U.S. completing a 6th straight day of strikes on Iran. The Associated Press reporting that bridges were among the assets targeted. Iranian state media saying 3 civilians were killed. President Donald Trump using a roughly 25-minute primetime address to revive claims that the 2020 election was stolen.
Of years, starting during the 2020 election cycle, the People's Republic of China carried out what is believed to be the largest compromise of election data in history, resulting in China's illicit acquisition of 220 million U.S. voter files.
Trump also accusing U.S. government officials of trying to cover up Chinese interference. Netflix reporting a 2nd straight quarter of slower revenue growth. The company projecting sales of just under $13 billion in the current quarter, slightly below estimates. Investors questioning the platform's growth trajectory as it bets on new offerings, including live sports. And that is your Bloomberg Brief. John.
Stock is down almost 10% in the pre-market. Vonnie, thank you. Appreciate it. Up next on the program, widening attacks on Iran.
We're making a record investment in our armed forces. We are likewise winning big in Iran, and you will see the fruits of that labor very, very shortly.
In just a moment, we'll catch up with Bloomberg's Tyler Kendall. Plus, we'll touch base with Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. Got the air quality index at 169 this morning. You don't follow the air quality index, that is super bad.
Very bad. I saw that the level was in the red of, quote, unhealthy, AKA don't go outside, which is why I'm worried about this weekend when it comes to the World Cup. I know it's supposed to clear, but is it really? Can you imagine running around 90 minutes in this terrible, foggy, hazy? It's very uncomfortable.
As bad, perhaps even worse in the last 24 hours than some of the most populous cities in places like India, which are well known for being very, very polluted. We're blaming Canada, right? Canadian wildfires.
Yes, it's their fault.
We saw this about 3 years ago, I think. That orange glow in the sky when the wildfires in Canada.
It's pretty for a moment, and then you go outside, you breathe it in, you're like, ooh, this is terrible. But yes, it did feel like some very polluted cities I've spent time in, like Delhi or Beijing. That's how New York feels right now.
Do you want to have a go at Carney this morning? Is it his fault?
Yeah.
Prime Minister?
Prime Minister Mark Carney, fix it, please. We can't breathe
Fix the
here
air
in New
quality.
York.
You know, come on. Look at what we're importing here. Okay. Equity futures right now in the S&P 500. Stay safe. Seriously, it's brutal. Got a headache just walking in it yesterday. Seriously.
I know. I feel really bad. Like my brother, he works outside all day. I feel for him. He's breathing this in. He didn't feel great last night.
Not good. Futures down 0.8%. This isn't good either. Stakes lower, of course. On the Nasdaq 100, we're down by 1.5%. On the Russell, we're down by 0.5%. It's obvious on that picture right now where the pain is. The pain is in tech, and there are so many reasons for this. Positioning. This market was super bullish. Look at how we've responded to some of the decent earnings we've had. Stocks have traded lower, even though numbers from TSMC, ASML, Samsung over the past few weeks have been really quite tremendous on the tech side. The market has not exactly embraced it. Then the likes of Alphabet behind on a new Gemini model. That was the news from yesterday. The news this morning that China's maybe advancing with its own models from its own startups. That's dragging down the whole tech sector so far today.
Yeah, you could pick your poison when it comes to the catalyst and what you don't like right now in the technology space. And as you've been saying, it's almost priced for perfection. Bar has been so high for these companies. The shock this morning really does seem to be coming out of Beijing, though. Individuals saying this feels like a DeepSeek moment. To your point earlier, though, we moved through DeepSeek and it was fine. It was behind us. Is that going to be this time around, or potentially can Kimmy linger?
The Nasdaq down by 1.5%. Some risk aversion in the bond market driving yields a little bit lower. Backing off the highs of the last week or so, particularly the front end of the curve. At one point threatening to break into 430 kind of territory. This morning 411 and down another 2 basis points. This move in crude notable. We're up by 2% this morning. Brent pushing 86. WTI pushing 81. Under surveillance this morning. Widening attacks on Iran.
I'm proud to report that our country is safer, stronger, and far wealthier than it has ever been before. We're making a record investment in our armed forces. Unfortunately, we're forced to use it now. We are likewise winning big in Iran, and you will see the fruits of that labor very, very shortly.
So here's the latest this morning. The US and Iran clashing for a 6th consecutive day, with the US expanding targets overnight. Tehran refusing to back down on the Strait of Hormuz as the US enforces its blockade. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, it is increasingly clear that the U.S. is widening its list of targets, both by targeting Iranian infrastructure overnight, but also the fact that we're seeing the U.S. enforce its naval blockade now deeper into the Persian Gulf. Iranian state media confirms that the U.S. targeted and hit at least 6 bridges as part of an apparent effort by the U.S. to cut off supply routes to a key port city and naval base that the IRGC uses to disrupt commercial traffic. Now, CENTCOM says that it is still actively working to ensure freedom of navigation in the Strait, saying in a post overnight that so far the U.S. military has redirected at least 3 vessels, has disabled 1, and boarded another for verification purposes, this time in the Gulf of Oman, seeming to indicate a wider boundary for their operations. Observable traffic in the Strait remains subdued today, as data compiled by Bloomberg News shows the transits that are happening have actually largely been limited to Iranian-linked vessels that are using that Iranian-approved route in the northern corridor of the Strait that gets them closer to that country, showing that Iran still has this great leverage when it comes to what is actually happening and moving through the waterway. And John, at this point, we've gotten very little indication that Iran is willing to give up that leverage, now stepping up its retaliation against U.S. allies in the region. That includes new this morning, Kuwait confirming that Iran hit a water desalination and power generation plant that is now threatening water supplies in that country.
Tyler, appreciate your time. More from Tyler in the next hour. Tyler Kendall there. down in the nation's capital. To build on this, Tobin Marcus of Wolfe Research writing the following. The outlook in Iran is starting to look more genuinely concerning. It's not clear to us that the outlook on the war is any better than it was in the ceasefire period. Tobin joins us now for more. Tobin, welcome back. Let's talk about this. What do you think is happening here? This is developing pretty quickly. How do you think things will change over the weekend?
Good morning. Thanks for having me. Yeah, so look, I mean, the U.S., as you just noted, clearly is expanding the scale of attacks, going after some infrastructure targets, even if they're geographically confined to that area around Bandar Abbas on the northern shore of the Strait. That is a new qualitative category of targets that, I mean, that's generally been what President Trump talks about when he talks about how we might escalate, what the next set of targets we would reach for would be. It's things like bridges and the retaliatory Iranian target set now seems to be including things like water desalination plants. So we are seeing the scale expand. I'm seeing no sign yet that either side is reaching the limits of their resolve. It looks like things will get worse before they get better.
Tobin, do you think the United States will then start targeting energy facilities?
I wouldn't expect that we're going to want to put energy targets specifically into this tit-for-tat escalation. There's enough targets that we have to hit that are focused on what's still nominally the thrust of CENTCOM's operations, which is degrading Iran's ability to threaten traffic in the Strait. There have been some targets around the country, but this has been really focused on that area around the Strait rather than focused, say, on the capital in Tehran. So, I suspect that we're going to stay focused there. But as we're starting to hit, those kinds of infrastructure targets in that region, we need to worry about what the Iranians might try to hit in response.
The greater escalation would be, of course, the president decides to send ground troops. This was some reporting earlier this week from the Wall Street Journal. How likely do you think that is? Or do you think that is almost a negotiating tactic, a threat that this administration wants to socialize in the media?
Yeah, I have never thought that the options for sending ground troops make a lot of sense. We once again have reports about the possibility of occupying Karg Island. But the point of that Karg Island operation was always aimed at the exact same target that the blockade, I think, has addressed in a more effective and lower risk manner, which is cutting off Iran's oil exports. The blockade is working at its stated purpose. It is successfully interdicting ships. Whether or not that changes the Iranians' decision-making is a different question. But I think with the blockade in place, there's really no reason for those ground operations. And they do come with quite a lot of risk. Once you've put troops on the ground, then you're in a position of needing to potentially kind of get in deeper to protect the escalation you've already done, which is a really challenging position to be in.
Tobin, I want to ask you about China. Does the president potentially poke the bear with his speech last night when it comes to China, given the fact that China has been the country that has really put a lid on oil prices, given the fact that we've seen very soft import numbers from Beijing?
Yeah, they've been a hugely important buffer in global oil markets adjusting to this crisis. And of course, we depend on stability, so-called constructive strategic stability, using the language coming out of the last Trump-Xi summit, to maintain manageable situation in terms of export controls. So there definitely is some risk about antagonizing China. I think in a world where he's just going out in that speech yesterday and talking about Chinese election interference, but not actually doing anything about it, I suspect that Beijing is going to be willing to tolerate that. There's obviously been lots of tough talk on both sides, but if it's accompanied by sort of actual substantive consideration for this truce, that probably works well enough. And, based on the content of those allegations, which from the Chinese perspective mostly seems to be acquiring publicly available voter files, that's not something I would necessarily expect is going to be accompanied by concrete policy action against China.
Tobin, I appreciate your time. As always, Tobin, thank you. Tobin Marcus there of Wolfe Research. Two big reasons that crude this morning is in the 80s and not in triple digits. One is inventory, and the second one is, as you said, China and China's strategy towards energy.
And everyone in the market is just questioning, when will China potentially start to ramp up imports going back to where we were before the war? And what does that mean for the oil price? It means it's going to be higher.
Futures this morning down by close to 1% on the S&P, a whole lot worse for tech. Coming up, we'll catch up with Alicia Reese of Wedbush as Netflix fails to meet expectations. blame game this morning. So many reasons for this sell-off in tech, China being one of them. We'll get into that in just a moment. Here are the scores. Equity futures pulling back. We're down by 0.8% on the S&P, heading towards the first week of losses so far this month. Coming into Friday, as of the close on Thursday, chip stocks down by more than 8%. The semis facing the biggest weekly drop since the Liberation Day week mess of last April. It's been that long. On the Nasdaq, we're down by 1.6%. Let's turn to the bond market. 2s, 10s and 30s. Yields pulling in. There's your risk aversion. That's a picture of it. We're down 2 basis points to about 412. On the week, at the front end of the curve, yields have dropped by almost 10 basis points, around 10 basis points so far this week. Softer CPI and PPI have helped that move, contributed towards the story that maybe we can avoid the urgency of hiking interest rates sometime soon. Perhaps just removing that and taking July off the table for now. This, though, will keep the pressure on. This move in crude. WTI and Brent just elevated through the week, and so far on the week higher by more than 10%. Brent around 86, WTI north of 80.
And it looks like the escalation is going to continue, even more so into the weekend. And as we just heard from Tobin Marcus, you see this administration expanding their targets, going after bridges, going after ports, making sure that there's any sort of infrastructure that the IRGC is reliant on to then go after commercial vessels they are going to attack. Also, yesterday, we got some more color about how this blockade is working, even with the U.S. having to board a ship. So this blockade is very aggressive. Iranian crude, which at one point the administration lifted sanctions on, allowed it to go freely, is definitely sanctioned, and they are physically going after that product.
6 days of strikes. Another day, and this day slightly different, to Anne-Marie's point. As we can't get down to the open in about 3 hours away, let's get into China and the latest moves. Yahara has more. Hi, Yahara.
Exactly, John. And because of that, we are seeing the chip stocks lower, with NVIDIA, Intel, and AMD all falling in the pre-market, extending yesterday's losses. And the cause for the jitters is the release of this new AI model out of China from the company Moonshot. And its AI model supposedly rivals the strongest offerings from the likes of OpenAI and Anthropic. So that is raising fresh concerns about whether cheaper AI models will mean less spending on these pricey chips. And it is just reviving memories from our DeepSeek moment last year when that groundbreaking model shook the markets. Meanwhile, we are seeing SpaceX lower, and for the first time since its blockbuster IPO, it closed below its offering price yesterday, and now shares are down 3.6% in the pre-market after the company scrubbed its latest Starship launch when several engines failed to launch. Now, the company does plan to try again in the coming days, but it is a setback for the rocket at the center of Elon Musk's ambitions with this company. And we end on a big mover to the downside, and that is Netflix, now down more than 10% in the pre-market after the streaming giant forecast a second straight quarter of declining sales growth. And with the stock down 40% over the past year, patience is wearing thin. Investors concerned that the company is just not delivering the hits that it used to. John?
Yahara, thank you. Reaction from Wedbush just moments away on that stock. On our radar this morning, let's talk about it. SpaceX calling off its first Starship rocket launched since its IPO. Plumes of smoke erupting from the rocket's engines as it's attempted to take off. The company aiming for another attempt in just the coming days. The stock, as Yahara pointed out, is down by close to 4%. Elsewhere, Google facing significant delays to its latest AI model. Sources telling us here at Bloomberg the new Gemini model is running into issues with coding capabilities. Google struggling to keep up with OpenAI, Meta and Anthropic in the AI arms race. And finally, let's talk about that arms race. China. The Chinese AI startup Moonshot releasing a powerful new model that the company says rivals the performance of top US tech firms. The release triggering a major global chip sell-off, sparking fresh fears about the industry's massive spending spree.
And people are saying potentially this is China's version of Fable when it comes to what Anthropic has and Mythos. And this is going to be open source. And it challenges this idea that we have here in the United States that, one, China is months or years behind us, potentially not. And Jensen Huang once said this to me. They are right there with us when it comes to the race. And two, how much money does it cost? Because this looks to be a lot cheaper than what individuals are paying up for some of these top models out of OpenAI and Anthropic.
If it is truly export compliant, right?
100% agree.
And to your point, I don't know that this morning. We were told, I remember when we had that DeepSeek moment, I think NVIDIA came out pretty quickly and said it was export compliant. I'd be looking for something similar in the next 24 hours.
Yeah, I think we would want to know exactly how they are building these models, because our models are built on the most advanced chips that China is not supposed to have access to. And we do know that they want access to the highest U.S. models, but those have export restrictions on them. Now, can they get them on the black market? Yes, potentially. And if so, is that what they're using to create this new Kimi model that everyone's having this DeepSeek moment this morning
That
about?
DeepSeek moment didn't last too long. We had this kind of price action, then we moved on. You wonder whether this is different. I don't know. The backdrop for me is slightly more important right now. You think about the backdrop. Positioning and price is important. And I think that with the earnings we've had so far from ASML, from TSMC, from Samsung more recently, it just exposed how long this market was. Earnings were great, market didn't respond to it. So that's your backdrop right now for positioning. Then you get to the substance, the recent developments. It's just been a fragile 24 hours. The latest from Google, that the Gemini model has been delayed. That's not helpful. This is like a 1-2 punch to sentiment with this again this morning.
Right. It wasn't even just what happened with Google and Gemini. They seem to be behind, but also what is going on in terms of SpaceX. Those rocket launches are incredibly important, and now SpaceX is a publicly traded company. Broader tech sector. Netflix not doing so hot this morning and overnight, slowing when it comes to how quickly that company is keeping up. So there's a lot of different catalysts you can choose. And as we've been saying this entire week, the bar for these companies is just so high.
Still the number one question, can we justify the massive spending in this market right now that's really supported the huge moves we've seen in chip names? Annmarie mentioned Netflix. Let's talk about it. Shares of Netflix sliding in the pre-market, down by 10% following underwhelming earnings. The streaming giant forecasting a second consecutive quarter of slowing sales growth. Alicia Reese of Wedbush maintaining her outperform on the stock, but lowering her price target to 105, writing, "This is less a change in conviction on the destination, but rather an admission that it's a longer runway to the next growth spike." Alicia joins us now for more. Alicia, welcome to the program. Ahead of earnings, you talked about the failed pursuit of Warner Brothers. Can we just back up and start there? Why this stock has traded so poorly since the collapse of that pursuit?
Yeah, I think it was less to do with the collapse of that pursuit and more to do with underwhelming earnings along the way, underwhelming guidance, and Reed Hastings exiting the board. Those factors altogether just didn't give a lot of confidence. And since a lot of people have been digging into the data dump numbers that Netflix provides on a semi-annual basis and got concerned about, some of the things they were seeing, with the second seasons and engagement pulling off. A lot of that's been going on for some time now. It's not new, but the digging into it has been a little newer. What I'd say from the results that they just hit is that second season, the hits do hold. The weaker shows have been fading, like Bridgerton held up 4 seasons, and Running Point both fell 50 to 60%. It's not a crisis, but the Discovery is favoring new titles overall. But there were concerns this quarter.
Alicia, I know you've touched on engagement. Can we just build on that a little bit more? I was reading through your recent note. How much of it has just been mechanical because of the password sharing crackdown? How much of it is really a reflection of a weak slate of content? How do you draw a distinction between one and the other?
Yeah, so I'd say early on it was an issue of the password sharing crackdown. It took some time to see that wasn't the only issue, but I would say the data dump that we got yesterday, the engagement is back. The first half of 26, the hours were up almost 2%, and Netflix confirmed that on the call. This is the third straight half of acceleration, so that really the bear case's core metric is moving in the wrong way for the bears. That being said, there are still some concerns, but I'd say on the engagement front, the data is moving in the right direction. But right when the data is moving in the right direction, Netflix decides to shift that data disclosure to an annual cadence starting in 2027. So investors are going to get less proof, and that's right when the data is starting to turn their favor.
How are they doing in terms of new podcasts, video games, live sports? Is that where they're driving some of the growth?
Yeah, it certainly seems so. I'd say live sports is really a Trojan horse. It's 1% of the hours. that we see in that engagement report. And so the engagement, if it was, more reflective of overall revenue growth for the company relative to the amount of spend, we'd see, a really significant growth driver there. But it's really just 1% of the hours, but it's really effective hours. That's, 6 of the last 10 sign-up days and significant advertising revenue growth on there. So that's a really active engagement. Games, on the other hand, sounds like it's doing great. Cloud players up to, 11% since October, or 11 times since October, but we don't have any real data to dig into, to sink our teeth into there. So I'd say on the surface, it looks like it's doing great. It's got a long way to go, but it's really encouraging. But not a lot of data to go on with the podcasts and the games at this point.
How does Netflix fend off basically what we're seeing on the internet every day, which is short videos, whether that's even on Twitter or YouTube, made by AI with a generation that has an incredibly short attention span?
Yeah, I think pulling on the podcasts, doing games, and all of these things are more mobile friendly, mobile first. And so they are seeing more people connecting on their phones and connecting with this type of content. They're going to have more lifestyle content. I think a lot more content creators putting shows on Netflix and creating probably shorter content. And a lot of that is accessible on phones. So they just have to train their users to access them in the ways that they need in any given moment, and then still win them in the living room.
That's a shift. That's a change. Alicia, thank you. Alicia Reese of Wedbush. The stock is down by close to 10% of the pre-market following results. I would just say X has done a phenomenal job with the algo, particularly around the World Cup. The content has been phenomenal. And Annmarie, it's been so good that the other day I went into the settings of my iPhone and limited the amount of time that I could spend on X to an hour a day, because I found myself with the World Cup content just going deeper and deeper down some kind of burrow where I've just been sort of like scrolling. And before you know it, time's just passed. Just like that.
Doom scrolling. That's what the kids do.
It's crazy.
That's what the kids do on TikTok. And it's interesting because people now are also starting to just watch full-on videos and movies on their phone. I actually had this conversation with Matt Damon once. He was shocked when people used to watch movies on their laptop. And I was like, that was me in college. And he's like, now I see people watching full-fledged movies on their tiny screen on their phone. He's like, we're not produced. They're not made for this. But that's the direction of travel. And that's why companies like Netflix need to make content that fit on a mobile screen.
Haven't you been doing the same thing on X over the last month?
Yes.
Because of the World Cup?
The messy memes lately,
phenomenal.
the messy memes last night, I probably watched every single one of them.
I've had to limit myself. OK, let's get you an update on stories worldwide this morning with your Bloomberg brief. Let's get to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. Andy Burnham taking over as UK Prime Minister Monday. Sources telling us here at Bloomberg he's planning a series of public statements in his first days in office to mark a change from the previous administration. Burnham is expected to announce plans for new drilling in the North Sea and public control of Thames water. Apple targeting dozens of OpenAI employees with legal warnings. The Financial Times reporting Apple is looking for evidence to support its claims that the ChatGPT maker stole its trade secrets. Argentina and Spain facing off for the World Cup title on Sunday, but first, France and England play for the third place medal. They'll face off in Miami tomorrow. England eyeing its best finish in the tournament since winning it all the way back in 1966. John, that is your Bloomberg brief.
Vonnie, thank you. I cannot think of a more pointless game in the world of sport. Anywhere, any sport, there is nothing more pointless than the third place playoff in the World Cup coming up on Saturday.
I actually forgot that they do that.
It is absolutely ridiculous.
Yep. And it's kind of like, how do you go play
for that? Do you think any of those players want to be playing a single minute of that game on Saturday?
Absolutely not. They're all just sad. They want to go home and have,
How many people even want to watch
summer. I don't know. I'm not going to watch that game.
Ridiculous.
I'll watch Sunday, of course.
That would be in my manifesto of changes if I was going to be the president of FIFA.
I can't wait for you to run FIFA one day.
Can I still host the show?
Why not?
And run FIFA?
Why not?
Why do we need a shot of him in every game? Why do we need to see the person of the governing body of the sport in every game?
It must be in his contract or something.
What's
Show that
about?
I've made every game.
Every game.
It is, to be fair to him, though, it is pretty incredible how he's made almost every match. Is he just not sleeping? Obviously, private jet and all that, but...
Don't want to know. OK, that's on Saturday if you're interested. I'm not. Maybe someone is. Looking forward to Sunday. Up next on the programme, doing more with less.
We effectively just grew the earnings 30%, and we have a little less people we had last year. We want to have more production capacity. We are hiring a lot of people. We have to hire 1,300 people a month to have neutral headcount.
Nela Richardson of ADP joins us in just a moment. Live from New York City, you're watching Bloomberg Surveillance. Okay, different perspective. I'm open to it. Rodrigo from Chile says a different point of view. I'm from Chile. We still celebrate the third place in 1962. I agree it doesn't matter, but oh boy, small countries would love for third place.
Okay.
That I appreciate.
That I appreciate too. It's just for the English fans, and having lived in England, they were desperate for it to come home again. And I think France really, I mean, people had France in their brackets as potentially winning this whole thing. So if you thought you were potentially going to win, playing for third place is kind of funny, but I have to say, as an American, it's kind of funny to see it being France and England.
That's the one half of my bracket that I actually got right. The notable thing I got right was Spain beating France in the semi-final.
So
that was like the one thing.
So who is your bracket?
The rest of the bracket's dead.
Brazil.
Because Brazil was on the other side.
I would have. I didn't fill it out, but I would have chosen Brazil as well because they're just incredible.
Thank you for writing in. I respect that. Equity futures right now in the S&P pulling back by 0.8. On the Nasdaq, we're down by 1.4. On the Russell, by 0.5. Some tech jitters. We'll spend the morning talking about them. There's some risk aversion in the bond market too, driving yields lower. 2s, 10s, 30s down by 2 to 3 basis points this morning. 412 on the 2-year. And commodities very much in focus. 6 consecutive days of strikes on Iran. The scope of the strikes broadening is changing. Brent crude this morning close to 86. Under surveillance this morning, let's talk about the jobs market. Doing more with less.
We effectively just grew the earnings 30%, and we have a little less people we had last year. We want to have more production capacity. Our job is to handle it well and redeploy people. Last year, we redeployed 14,000 people. We are hiring a lot of people. We have to hire 1,300 people a month to have neutral headcount.
So here's the latest this morning. Wall Street's biggest banks just had a record-breaking 2Q, even though they shrunk their workforces by the most in at least 6 years. Headcount at Bank of America, Wells, Citi, Goldman, Morgan Stanley falling by more than 10,000 in the second quarter. Nela Richardson of ADP remaining optimistic on the jobs market, writing advances in artificial intelligence are set to restructure formal and informal labour markets, bringing new tools and transitions. Nela joins us now for more. Nela, welcome. Are we seeing a trend here emerge, maybe not just on Wall Street but elsewhere, that perhaps predates what we saw with AI, that this has been building for a while, that these companies are being able to do more with less?
Well, happy Friday. And this is not a new trend. This is what companies do. They redeploy. They change their talent pipeline. They create new sources of growth through employment change all the time, and we've seen that. What's new is the global nature of the labor market. I'm struck by Brian Moynihan's comments of they have to hire 1,300 a month just to stay neutral. Where that hiring is going, I'll bet, it has increasingly changed. It's not just a U.S. labor market anymore. It's a global labor market. And so this low hire, low fire number that we get every week in the initial jobless claims is actually hiding a pretty big structural change of how firms, whether it's banks or even very small, medium-sized firms, are hiring globally. It's not showing up in U.S. employment, but it's keeping the global labor market, the unemployment rate, well below what it was pre-pandemic.
So, Nela, we don't need to worry just yet that AI is taking our jobs, does it? You're saying this is looking healthy, and is there going to be a peak at some point, or is it just all going to continuously to change?
Well, that's a great question. It's a fascinating time period. AI is also a global investment thesis, right? Data centers are not just being built in the US, they're being built globally. And that talent that goes with that data center construction will also be global. And so we don't know. I mean, to be very modest on a Friday, we don't know what the ultimate end game of this AI investment will mean for the American worker. But what we do know is that it's not the only game in town. The demographic pipeline is being scrambled in real time. Nobody talks about it because it's boring. It's like a third place game on Saturday. But really, it's that structural change in terms of demographics with all these people rolling off that have to be rehired from talent abroad or younger talent. That's the real story of the labor market, that and how concentrated it is. So AI has not yet made a national dent, though we are seeing pretty sizable impacts when it comes to early career in AI exposed fields.
You also talk about the informal sector of the job market. Are you seeing a pickup of jobs there?
Yes, and this is data from the ILO. And again, this is a global story. So we always talk about the formal labor market. That's what we have data on. But the informal sector is alive and well and extremely active and not going away. In that informal sector is everything from babysitters and caregivers to landscapers to repairmen. The list goes on, and it translates around the world. And as prices increase, because global inflation is higher than average, people start to turn to those informal structures in order to get goods and services. And so you'll see that pick up as we have this aging demographic in the United States. Home health care aides won't just be coming from hospitals, they'll be coming from next door, around the corner, your neighbors. And so how that structure changes over time will be something I'll be watching very carefully, but it's hard to measure.
And Nela, it's hard to measure, which makes it difficult to set policy for. How does this affect and influence monetary policy? How do you think it will in years to come?
Well, I think they're going to be still laser focused on what we can measure. They'll be looking at jobs created every month, but I think it's going to be harder to figure out what the neutral rate is because you have all these cross currents under the surface. There's been talk that the neutral rate was 0. There's been talk that the neutral rate for employment was 50. We really don't know. It's like a unicorn in the forest. We see glimpses of it maybe, but maybe it's just our imagination. But that neutral rate won't be telling. What will be telling is some things that we can measure, like long-term unemployment, which is up. That 27 weeks of the long-term unemployment is the highest we've seen in 4 years. That's a telltale sign that there is some weakness under the surface, and it's really going to be up to more data to figure out where that weakness lies.
Nela, appreciate your time. As always, fantastic explanation of what's happening under the surface, beneath the surface in this labour market. Nela Richardson there of ADP. To Nela's last point, it's been difficult. If you've been out of a job, it's harder to get back into the workforce, and the data backs that up. And when you hear these conversations every day about the labour market being okay, the economy being good, and you're listening to that and you're the outside of the labour market right now, that's certainly not what you feel.
Oh, no, absolutely not, because you're just waiting on potentially getting that break and getting back into the labour market. But if you are in the labour market and you're holding on to your job, Nela's been talking about this for months. We have been dealing with a low hire, low fire environment. What the Fed right now is focused on, though, is squarely on inflation. They're not focused on this labor market right now. They're focused on the fact that we have seen some good numbers this week when it comes to disinflation, but then once again, oil is elevated now, and potentially does that disrupt things?
It's a complicated, nuanced backdrop, but they've got to answer a simple question. Is the labour market a major source of inflation right now? Now, relative to the situation coming out of the pandemic, the answer to that right now on a relative basis is no, it's not. And maybe that's a source of comfort right now for some of the devs on the committee. They'll have that family fight a few weeks from now. Coming up next, we'll catch up with John Stoltzfus of Oppenheimer, Jeannette Lowe of Strategas, Jeff Currie of Altis Partners, and Dominique Toublan of Barclays. The second hour of Bloomberg Surveillance is just around the corner, with equity futures on the S&P negative by 0.8%.
We're very bullish at the U.S. economy.
We've continued to see the economy remain resilient.
Financial conditions appear to be extremely easy.
Net a healthy economic backdrop.
I just don't see a recession in the horizon.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Here are the scores. We're down by 0.8 on the S&P. On the Nasdaq, we're down by 1.5. Look at that snapshot. Clear underperformance of the tech trade, not just stateside, but worldwide. Let's get into the why. The chip stocks have been getting hammered recently. As of the close yesterday, the semiconductor index down by close to 20% from the highs of June. Only 3, not even 4 weeks ago. Nvidia down again in the pre-market by close to 3%. You're seeing this elsewhere as well. Annmarie, the focus on China this morning.
Yep, the China shock this morning. That's really a cherry on top of the cake when it comes to this trade and the growing scrutiny around this trade if all the spending justifies these valuations and when we actually see all of this come to fruition, because China is out with another DeepSeek moment. It is a new model. They're calling it the Kimi moment. And it's going to be a lot cheaper when it comes to this model versus, say, an Anthropic Mythos, an Anthropic Fable, an OpenAI model. They are basically saying, individuals that are aware of this model, that it is operating on that level, and it looks to be much cheaper, and it's going to be open source.
How difficult is it to justify the spending stateside? That is going to dominate the questioning of all the market guests throughout this morning, with futures on a back foot, down by close to 1.5 on the Nasdaq. We also need to talk about crude. WTI and Brent pushing higher once again. On the week so far, higher by more than 10%, up around 11. Could be one of the biggest weekly advances we've seen going back to, I think, April. On Brent this morning, around 86. On WTI at 81.
And as of last night, you had CENTCOM come out and say U.S. forces completed a 6th consecutive night of strikes against Iran. And then this morning, the Associated Press is reporting that those strikes are continuing. And we've seen lots of reporting that they're going after different infrastructure now, the U.S. forces, things like bridges, the infrastructure that the IRGC is very reliant on to move munitions, to move hardware, to move people, to then go after commercial vessels. On top of that, Jonathan, it's a very aggressive U.S. blockade once again when it comes to those Iranian vessels trying to leave port.
Put the two sources of risk together. You've got some risk aversion. Into the bond market we go. Yields declining, down by 2 basis points on 2s to 412. On 10s this morning, down 3 to about 452. Yields have been pulling lower, pushing lower through the week so far, not just on the risk aversion, but also on the data. PPI and CPI softer this week, going into the Fed's next meeting, only a few weeks away. So that's the cross-asset price action. Coming up this hour, we'll catch up with John Stoltzfus of Oppenheimer, with chip makers facing extended volatility. Jeff Currie of Altis Partners on a 6th straight day of attacks on Iran. And Dominique Toublan of Barclays warning hyperscalers are nearing an inflection point. We begin this hour with stocks adding to losses as Wall Street continues to rotate away from chip stocks. John Stoltzfus of Oppenheimer writing, some investors appear to expect investments in AI infrastructure to show profitability so soon. In our view, patience is called for, particularly to opportunities tied to dramatic innovation. John joins us now for more. John, good morning.
Good morning,
Is
John.
this one of those mornings where patience is called for?
I think most certainly so. And I can't help but think, when you look at this, if the big story with technology is it always gets cheaper, there's compression. But at the end of the day, if you reduce the unit price cost and you increase popularity or usage across deeply embedded both business and the consumer in any kind of technology, you can make up in volume what you lose on individual
Does China
pricing.
risk derailing that with the developments this morning?
But the one thing, of course, with China is what kind of security do you have if you use a DeepSeek or this latest programming? China's not a great business partner. It's been proven since COVID. That's why we have the globalization process is going through a huge re-diversification where many other countries will participate, and all roads will not lead to China.
I would agree with that, and a lot of other people would too. But the question they'd ask is whether China this morning is demonstrating, and whether they have demonstrated more recently, that you can make these technological developments, these leaps, without spending as much money as we've been spending in America. How would you respond to that?
Well, I would likely respond to it. I will respond to that by basically saying I think they're great copiers. So once we've moved ahead, they take what we've got and then they learn how to make it cheaper. That's been going on since Japan and Korea were involved making toys or lunch boxes, what have you, since when I got into the business, before I got into the business, for the last since post-World War II. This has not been atypical, so I think it should be expected.
John, you might be concerned with China and when it comes to national security and how safe your data would be if you were used one of their environments. But I'm not sure the younger generation that's, engrossed in TikTok or other countries around the world actually care. So if China offers a cheaper model, what's going to be the U.S. counter-argument to that?
Well, I think, experience has a lot to do with it, and context is so important. And not knowing that, there's a lot of people today who don't recognize that there was once such a thing known as an analog rotary phone. There was a time when we used to use pay telephones, charge cards to collect calls, and it used to be doing a long-distance call was something you watched how long you were on the phone for. You didn't have a basic price you pay and then talk as much as you like. Same thing, and it's worrisome. I think today, among the things as a capitalist that concerns me is the largesse that's and latitude that is given to communism and socialism, which have been proven failures since they emerged in power. Wherever you go, you see it, and I think eventually people learn. Sometimes they have to get burnt.
Do you think the bar has been recalibrated now, given the fact that the bar was set so high going into earnings, and even if you met the bar but didn't have greater expectations for the future, you were punished sharply and harshly? Yeah,
I think that the problem with the bar this day, especially in this earnings season, for example, is that what you do have is you have, if companies disappoint, they'll be brutalized. If they come in and they beat expectations, but it's not, even if it's super superlative, they'll likely find the traders will say, well, what's occurred here is we bought the rumor, now we're going to sell the news. But that's very typical, and you've got that battle going between the traders who are highly leveraged, looking for an immediate gratification, and intermediate to long-term investors who have the opportunity to pick up babies that are getting tossed out with the bathwater.
So, John, how do you respond to that then? Because it feels like we're learning something about positioning and price this morning, and over the last week we saw it with Samsung, saw it with Taiwan Semi as well. You need to mute your phone, John.
Oh, I'm sorry. I even have the volume off.
I've muted your terminal for you mid-conversation too.
It's amazing what John's able to do.
Don't worry about it.
He can speak, type, mute terminals. It's pretty incredible sometimes.
Hoping the full screens might cover it up when I was doing it. Anyway, let's try and get back on track.
Please.
We've learned something over the last week about positioning and price.
Yes.
That even with fantastic earnings in the tech space, they're not being rewarded. And if you miss right now, you'll get absolutely obliterated. IBM's a great example of that. With that in mind, why would you want to be in tech going into the next week or so when we get those tech earnings?
Well, I think it's because the reality is we're all on the upgrade cycle, whether we like it or not. And the choice is you stay involved or you fall behind. So you need to be diversified, though. So you're not just incredibly overweight and only in technology. You also own things like materials. You're going to want to own some energy. Oh my gosh, energy, really? Financials, healthcare. There's 11 sectors. We find being diversified in a portfolio, in a dividend growth portfolio, allows you to ride these storms. You can be a rider on the storm.
I was going through your favourites, and the obvious jump out: IT, information technology, communication services, usually favourites on Wall Street. Consumer discretionary is in there too. What do you like about discretionary right now?
What I really like about discretionary, it's very well hated, even though you see some stores that before were really suffering in this last reporting season. I was looking yesterday, I saw a few stores, because I manage money, I can't mention the name specifically, but I went, look at these guys. All of a sudden, they're catching a bid. There was something we sold last week because it had just been putrid, its performance. And it all of a sudden, it caught a bid yesterday. And I don't know if it's just because, suddenly people, it's the traders tend to swing back and forth. There's a usage of the term is stocks bounce between gains and losses. And the pattern that we're seeing now has been repeated countless times before in the last 3 or 4 earnings seasons. It's always as soon as the financials come out, it's spectacular growth, wham, they slam them down, or they at least trim them. And happens with tech, and then they'll buy them back a few weeks later or a month later. But we think the trend is in place. And if you look at technology all along the way, many of these hyperscalers, survived the tech bubble and then thrived thereafter. This is not like the tech bubble where you had a group of young people saying, someday we'll have 1 million eyeballs on our website, not realizing you need billions and you need to refinance your debt along the way. They had burn rates. There's a lot of sophistication in this. It's not that there won't be mistakes. It's not that there won't be perhaps even failures. It's not that perhaps some big names will become smaller names or get consolidated. But this is a trend. This is like the smartphone versus the brick or the BlackBerry thing. You know, this is that type of a change, but it's even broader. And as it gets cheaper, usage will become greater across the business space as well as all the way through the consumer, I believe.
John, it's good to see you.
Great seeing you.
Always entertaining to catch up with you, sir. Appreciate it. Thank you.
Thank you for the time.
I'm not sure it's still muted, but we'll try and figure that out. Don't know what happened with it. John, thank you. John Stoltzfus there of Oppenheimer.
He might have extra.
Difficult to silence those new phones, right?
Yeah, I don't know. Maybe it's a watch. My mom's watch is always buzzing.
Oh, it's always buzzing.
Crazy.
It's beeping.
Yeah, just
okay.
put that on silent.
It's a generational thing.
Yeah, maybe.
I wasn't saying that, John.
I was.
It might have been. It might have been. I wasn't.
The phone is insisting on showing there's context.
Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie, I wish I was that popular.
I'm sure you are, John. Well, in other news, American forces boarding a ship in the Gulf of Oman. CENTCOM saying in a post on X, U.S. Marines boarded the vessel, quote, to ensure full compliance with the ongoing U.S. naval blockade. CENTCOM also saying it redirected 3 commercial vessels. Google is months behind schedule on delivering its latest AI model, Gemini 3.5 Pro. Sources telling us here at Bloomberg the company is working on improving its capabilities, particularly in coding. Dense smoke from more than 100 Canadian wildfires spreading across a vast stretch of the United States. According to the U.S. Air Quality Index, alerts have been issued for cities including New York, Chicago, Pittsburgh, and Toledo, Ohio. Residents are urged to stay indoors or limit time outside. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Thank you very much. That air quality is absolutely awful. Have you ever seen someone get so many messages in such a short amount of time?
No, I think it was someone saying, look, I see you on TV, you look great.
Oh, is that what it was?
Yeah, but not realizing his phone wasn't silent.
It's good to see him upgrade the phone too, because people who know John will know that he was rocking a 6S up until recently, an iPhone 6 up until very recently.
Oh, no, I actually know people, no offense, of your generation that still have the flip.
Oh, God help them.
Oh, right, okay.
Nokia flip.
Oh, really?
Yeah, old school.
Okay.
Of course, they can't see pictures of their grandchildren or of their.
But you're pretty secure.
Oh yeah, that.
John, thank you, buddy.
Thanks
it's good
again.
to see you. Thank you. Up next on the program, threatening ties with China.
Over a period of years, starting during the 2020 election cycle, the People's Republic of China carried out what is believed to be the largest compromise of election data in history.
Up next, we'll catch up with Jeannette Lowe of Baird Strategas, live from New York City this morning. Good morning. So here's the week ahead. Later on this morning, we'll get you some economic data going into the weekend, consumer sentiment numbers. One thing on this thing is more important than everything else, and I guess that's Sunday and the World Cup final.
Yeah, I'm still looking at the messy memes.
Who are you rooting for?
Argentina.
Okay.
Who are you rooting for? That's more of the interesting question.
A Brazilian household, I think it's obvious.
You're in a tough spot.
I think it's
you
obvious.
have no choice.
Look, I respect what Messi's done. I think it's amazing. The way he's changed as an athlete is just amazing. I remember watching him more than 20 years ago as a teenager come on for Barcelona. And it was very clear that he had this tight ball control that was reminiscent of Maradona. You could see very early on that this guy was going to be incredible. And everyone at Barcelona was pretty aware of it too. The superstar at the time was Ronaldinho. And the idea that he would get to those heights was like, if he can do that, that's amazing. He has surpassed that and some. And the way his game has changed, he went from that to prolific goal scorer, which is just incredible. Then he goes off to Inter Miami late in his career, and we're sitting there and we're thinking, he's done. This is over. Like, if you could turn up for the World Cup for a bit of a swan song, phenomenal. But look at the way he's changed his game. All of a sudden, he's become a world-class crosser of the ball. 25, 30-yard balls off the right and left foot, just perfect onto people's head. I've not seen that from him before. Usually beat one man, two man, look for a short pass. The way he's changed his game even now at an age where, like, I'm 18 months older than him. And the idea he's still playing professional football at this level and not just 45-minute cameos, 90 minutes plus.
Grinding the whole 90 minutes.
Against the best talent on the planet.
That are younger than him. That at one point he was
15,
bathing.
20 years, yes, literally.
Yeah, UNICEF came out and said that photo's real.
Yeah, I just find it absolutely amazing. For me, being a bit older, the nostalgia of Maradona, for me, that he was the greatest ever. To see what he's doing now, every minute he plays, every game he's played subsequently, it's pretty obvious now, it's hard to deny. The greatest ever.
Yeah, he's the GOAT. And what's interesting is if you would have known 10 years ago that Argentina beat England at the very end of the game by 2 goals, you would have been like, oh, Messi must have scored both. Actually, he was the assist for both.
You say that, Annmarie, you know, if you told me that 10 years ago, I wouldn't have thought he'd be playing the game. 2018, they were talking about him not playing for Argentina anymore. And here we are 2 World Cup cycles later, and he's on the verge of winning the thing again. Just amazing. Let's talk about something more important financial market-wise, shall we? Equity futures on a back foot this morning. Equity futures down across the board. On the S&P down by 0.9. On the Nasdaq we're down by 1.65. On a Russell down by 0.6%. Clear underperformance in tech so far this morning. And China front of mind, top of mind, not just for the markets but also for the politics. Under surveillance this morning, threatening ties with China.
Over a period of years, starting during the 2020 election cycle, the People's Republic of China carried out what is believed to be the largest compromise of election data in history, resulting in China's illicit acquisition of 220 million U.S. voter files.
So here's the latest this morning. The president accusing the Chinese government of interfering in the 2020 election, claiming Beijing stole sensitive voter information. The allegations from Trump coming just weeks ahead of his high-stakes meeting with Chinese President Xi Jinping in September. Bloomberg's Tyler Kendall joins us now from Washington. Hey, Tyler.
Hey, John, good morning. Well, the White House's claims no doubt risk derailing what has been the fragile truce between the two countries ahead of both Xi Jinping's visit here to Washington, but also the midterm elections. As you heard, President Trump outlined that one of his claims is that the Chinese government stole nearly 220 million voter files related to the 2020 presidential race, as Beijing is out with a new statement this morning denying those allegations, calling them, quote, purely fabricated. And Bloomberg News found that many of the documents released last night by the administration were heavily redacted, appeared incomplete, or contained information already known. Now, President Trump's comments stopped short of proposing any concrete action against China, as relations have remained relatively stable, I think it's fair to say, since President Trump's visit to Beijing earlier this year. But now we have to add this to the risk of what has been growing tensions when it comes to a few different issues, including trade, but also, of course, technology related to artificial intelligence. John, earlier this week, I caught up with the Palantir CTO, and I asked him if he felt that there were national security risks with U.S. companies using Chinese open source models, and he told me he believes that China is stealing American IP from Frontier Labs.
Tyler Kendall with the latest. Tyler, thank you. That's what we were going to get. How much of this is export compliant? How much of this is borrowed elsewhere, let's say, versus internal development, their own IP? I don't know. I don't think anyone knows at this point.
Yeah, how much is this potentially individuals meeting other individuals, stealing some information, copying it from the Anthropic OpenAI types, and then running it on chips that are actually technically banned in China? These are questions that I imagine everyone in Washington, D.C. will be asking.
Without a doubt. And at the same time, that's a debate we've got to have. But I think you also have to respect that there have been significant technological leaps that have taken place in China. And that it's not just about stealing technological progress that's happened elsewhere, that things aren't being done domestically there that you have to respect and be aware of. And I've heard that repeatedly from tech CEOs over the past few years.
And it's happening not just in the technology space, but driven by, supported by the Chinese government, plowing money into this.
These have been massive goals. Let's build on some of this. Jeannette Lowe of Baird Strategas joins us now for more. Jeannette, for a moment, things were calm. The relationship between China and the United States, I won't say was great, but I'll say things were stable. What's changed?
Yeah, I mean, I think that this is really important. When you heard the U.S. Trade Representative Greer talk earlier this week about the U.S. and China, he kind of made that point that it is all about stability in the relationship between the U.S. and China. However, before these meetings, we do know that we're 2 months away from the Xi coming to the U.S. It's not like we're 2 weeks ahead of this, but the U.S. does still raise some of the issues that it has with China. Obviously, IP theft is one of them. Doing the race with the AI is going to be a key focus for the Trump administration going forward. So you're always going to see these raising of these irritants, of these issues that we have. He said they're still not getting all of the supply of the rare earths that they're looking for. And I think we're going to continue to see that. It also gives them something to talk about at these summits. Since we're not getting large deliverables, we are just kind of seeing a stability of the relationship. And so I think this is going to be something that's going to continue forward. Stability with also having, some tension points as well.
Do you think Congress has more work to do to look at some of these AI models coming out of China and seeing how exactly they were produced?
Yeah, I mean, you definitely are seeing, at least among some factors within Congress, talking about really focusing more on China. Obviously, Chinese biotech has been a big focus for Congress as well. But the AI story, I think, is going to be important. I do think more of it's probably going to come from the administration than from Congress. You've definitely seen the Commerce Department working more quickly when they've seen like the mythos come out and being worried about what those implications can be. So I think you're going to see the ability more from the administration because they can move more quickly. They can do export controls rather than coming from Congress. But I do think Congress is going to be concerned about this as well.
I was with the president in Beijing, and it was really all smiles, soft, sweet talk from Trump to Xi Jinping, calling him one of his friends. And then he has these pretty spiky allegations last night. Why didn't he bring this up in the Beijing meetings?
Yeah, I mean, there may be that at some point when the cameras are off, they do talk about some of these things. But I do know that this has been, there are a number of issues that the U.S. does have with China. And I know that they probably bring them up at various points. Maybe they bring them up between the U.S. Trade Representative and Treasury Secretary with their counterparts before Trump and Xi get together. Because there is this point about the fact that Trump and Xi do have a strong relationship and that they can keep the relationship on track moving forward. That's been a key to this whole cycle. It's been a key in Trump's first term, but there obviously are issues and the U.S. does have to raise them. And we do see these things happen behind the scenes. Obviously last year with Trump's tariffs, that was a big push against China. China reacted with the rare earth mineral restrictions to the United States and to other countries. So you definitely do see the tensions, but I think obviously when they get in person, there is much more of the trying to placate to having a good relationship and showing the way forward. And that may be one of the reasons why we're seeing this come out now rather than, again, 2 weeks before the actual summit.
What's the top ask, you think, when Xi Jinping comes to the United States?
Probably continued release of rare earth minerals and continued purchases of U.S. agriculture and trying to maintain the relationship. But I don't see much more in terms of deliverables in the near term. Again, both sides continue to be focused on getting their own supply chains separate. Obviously, China is working to have AI models that do not require the U.S., at least in theory. And the U.S. is trying to get away from any reliance on China for rare earth minerals and for other goods. But we need time to do that. And so 1 year is not going to be enough. So we'll probably see a similar relationship happening as we saw last fall, happening again this fall, to how to create another year forward to try to move forward against each other and find their own self-dependency, self-reliance paths.
Jeannette, it's good to catch up. It's good to see you. Thank you. Jeannette Lowe there of Baird Strategas on the relationship, the evolving relationship, less stable this morning between China and the United States. Up next on the programme, Jeff Currie of Altis Partners with crude heading for its biggest weekly gain since April. Plus, Chadha has your morning movers. Hyperscalers sliding in the pre-market on fears of another DeepSeek moment. More on that a little bit later. Taking some more weight off this index this morning. We're down 0.8 on the S&P. On the Nasdaq, we're down by 1.63. On the week coming into Friday, heading towards the first week of losses for the month, chip stocks, the epicenter of the pain, down on the week by more than 8%, and that's before the losses this morning. That weekly loss, the biggest going back to April of last year. In the bond market, yields lower across the curve, bit of risk aversion, 2s down by 2, 10s down by 3, 30s also. Your 10-year this morning at 452, just slightly lower on the week. On the week, though, on 2s, the front end of the curve is where the bigger move is taking place on a weekly basis, down by some 10 basis points off the back of weaker than expected CPI and softer PPI as well. As we've said repeatedly, in the minds of many on Wall Street, just removing the urgency to hike rates as soon as July. In the commodity market, need to get you an update on what's happening with crude and the latest situation in the Middle East. We're bouncing again by 2%. Brent at 86. Let's round this one up following a 6th consecutive day of strikes in the Middle East.
Yep, last night they finished at 9:40 p.m. according to SecCom, and this morning the Associated Press says they were continuing as of Friday morning, going after, really expanding these strikes in terms of what U.S. forces are hitting, things like bridges. The president has foreshadowed potentially this is going to come. And then he also put another foreshadow. He said maybe the last thing would hit was energy facilities. Would we actually see that happen? Because that would mean a geopolitical risk premium added to the oil price that obviously this White House doesn't want to see.
86 on Brent, WTI north of 80, 2 hours away from the cash open. Let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. That AI breakthrough out of China is hitting the entire tech trade this morning after a startup out of the country called Moonshot unveiled a model that it says rivals the strongest offerings from the likes of OpenAI and Anthropic. So that is sending all the chip stocks lower this morning because it reignites this concern that if you have AI models that are cheaper to build, that may mean less spending on these chips, which are just getting pricier. Meanwhile, we are also seeing the hyperscalers under pressure this morning on that Moonshot news as well, because of that same question that if these AI models become more efficient, if they become cheaper, will companies need to be pouring hundreds of billions of dollars into AI infrastructure? So the market is punishing the biggest AI spenders, the hyperscalers like Amazon, Microsoft, because altogether they are expected to spend upwards of $725 billion on AI infrastructure this year alone. And there was nowhere to hide in this tech trade because we are also seeing Netflix getting slammed. It is down more than 10% now in the pre-market after the company forecast a second straight quarter of declining sales growth. And with the stock already down some 40% over the past year, patience is wearing thin as investors continue to question whether this company can deliver the hits that it once used to. John?
Yahara, thank you. Thank you for the update. On our radar this morning, let's build on our top market moving story. A new AI model out of China fueling a global sell-off in tech. Moonshot's Kimi K3 is said to rival the strongest offerings from both OpenAI and Anthropic. US semis already heading for their worst week since last year's Liberation Day market rout and adding to the losses this morning. Elsewhere, Meta taking another step towards its cloud ambitions. The Wall Street Journal reporting the company plans on hiring a top executive from Amazon Web Services. The reported move adding to Meta's teased plans to build a rival cloud service. And finally, the US enforcing its renewed naval blockade against Iranian shipping. According to Central Command, forces have redirected 3 merchant ships, boarded a vessel for verification purposes, and disabled a tanker that failed to comply with instructions. Let's build on that and stick with the war. The US and Iran exchanging strikes for a 6th consecutive day.
We're making a record investment in our armed forces. We are likewise winning big in Iran, and you will see the fruits of that labor very, very shortly.
Crude prices remaining elevated, heading for its biggest weekly gain since April. Jeff Currie of Altis Partners writing bottlenecks in the energy system are growing and widening. The entire energy complex remains underinvested, making the system extremely vulnerable to shocks like these. Jeff joins us now for more. Jeff, good to see you, buddy. Let's get into it. There's 2 words that stuck out for me in your recent work, and that's abundance, illusion. Can you just sort of flesh that out for us and why that's so important, perhaps more so at this specific moment?
Well, I think when we look at round 1 of what occurred in the Middle East, the immediate response was the U.S. to use strategic reserves. And we saw it in Japan, Europe, and elsewhere around the world, and they used it aggressively. China was flexing its system. Between the 2 of these, it created the illusion of abundance. But products are telling you we don't have an abundance out there. I like to point out, crude oil prices are the noise. Product prices are the signal. The crack spreads this morning are $70 a barrel. That means the spread between oil and products is nearly the same price of crude oil. I've never seen it that high in my entire career of over 3 decades. That's telling you this is no longer a question of deficit. This is now a question of shortage. And people are asking, where do you hide with what's going on in tech? Where you hide is commodities. They are the best performing asset class year to date, up 34%. Petroleum index alone is up 81%, and the upside is just that much greater between now and the end of the year, given the shortages that we're seeing across the energy complex. And if you put what occurred, round one, we got rid of the insurance policies, the cushions. This time around, we're starting from record low inventories. We have the Red Sea in play. We have the Straits of Hormuz in play. We have the Black Sea in play. We have refineries in Russia all out. The list goes on. In fact, I'd argue in my entire career, I have never seen an energy environment this tight, yet the world still focuses on tech that I think is poised for a big correction, and you have the best performing asset class out there being ignored.
Jeff, what we don't have in play, though, is China buying as normal. They're down some 40% in terms of their imports from the start of the war. When do you think China is going to step in again, and what does that mean for the price?
Well, we already see that the teapots are likely coming back because the margins, $70 a barrel. And what do those teapots do? They export to the global market. The profits are too big to ignore. And when we think about, the refinery outages in Russia, we just put it in perspective, it's really nearly 3 million barrels per day. That's almost half of the refining capacity taking out. You lost refining capacity in Venezuela because of the earthquakes. You've lost another 3 million barrels per day that sits behind the Straits of Hormuz. The profit incentive to refine oil into products right now has never been higher. And when we look at a lot of that oil that was, I like to call, the reason why oil went down when the Straits of Hormuz opened with the Memorandum of Understanding, it was like a pimple popping. It burst out into the system, put downward pressure on oil. A lot of that oil is sitting off the coast of China right now and likely going to. Yes, the big state-owned enterprises are slow to respond, but the other ones are a function of the underlying profits.
Jeff, why didn't we see the nightmare scenario, given everything you're talking about? Why haven't we seen $150 oil? Why is it still elevated, but it's comfortably at $85?
This is oil. Oil is a transfer price. It's noise. It's meaningless. We talk about it because usually the spread between the products and oil stays relatively constant. We're dealing with, this is unlike anything we've seen before. We've lost the oil. We've lost the refineries. The energy system is severely supply constrained. Product prices are telling you an entirely different story, whether it's prices in New York Harbor, diesel prices, $140, $150. In fact, right now, the product spread, that's all the products together versus the oil. This morning, it was $70 a barrel versus we're 85. So 85 plus 70, that gets you to 155. So you're already there. We have a very serious problem. And the consumer doesn't care about the price of oil. I don't know any consumer out there who consumes oil. They consume diesel. They consume gasoline. We have very serious issues. I'm going to go back to the point. The investment returns of owning the energy, a petroleum complex this year, forget oil, is up 81% right now, already year to date, because we have a problem. Everybody's focused on crude oil, but I like to point out, nobody that's focused on crude oil consumes crude oil. Only a refinery consumes crude oil. So when we think about products, it's a much more dire situation.
So, Jeff, let's talk about what's in our future. Gasoline prices right now stateside around $4. It's not great, but it's not crisis. What do you think that's going to look like deeper into summer?
It's going to go up. Where are you going to get the supply? And it's going to go up on a global basis because, again, we're thinking about, take Russia. Just for those who don't know what happened, Ukraine in the last several months is doing drone strikes, precision drone strikes, going 1,300 kilometers into Russia, taking out central, the CDU, crude distillation unit, taking out with precision strikes. Some of this stuff is going to take, years to rebuild. And when you think about what Russia is doing right now, They're supposed to be long energy. They're importing gasoline and diesel from India, jet fuel from Japan, which underscores the severity of their situation. They used to export 10% of the world's diesel market. And then to make sure they can't get the crude out, the Ukrainians are bombing the ships that would come out of the export terminals. And so we're all sitting there focused on, what's going on in the Straits of Hormuz, whether or not these ships, there's no products coming out. There's only, crude oil coming out. At this point, that's very de minimis. We also have the Red Sea at risk, and we have serious disruptions that are occurring in Russia. So again, my point being here, I think as you started to hear, the bottlenecks are shifting, but the trend is the same. And so you ask me what the risks are, they probably have rarely ever been this high right now.
There's one variable we haven't discussed, Jeff, and it's an important one. Annmarie and I were talking about this earlier on this morning, that the price of crude, and we'll start with crude and we can get to product in a moment, wouldn't be at 85 without China. It would be closer to 100. The change in China is important here, Jeff. They're not importing like they were. They stockpiled a lot over the last 12 months. They're not processing and refining crude like they were either. What kind of assumptions are you making on what Chinese strategies around crude and crude product is going to look like in the next 12 months?
They can't continue on like this forever. And by the way, everybody wants to blame this on China. China was part of it. But again, let's remember, they also exported the product. So they reduced. So let's say they've taken somewhere, if you do it against what would be a normalized level. And by the way, the rebound, if you look at the shipping data in the last 3 to 4 weeks, suggests there was a substantial rebound there, particularly with the tea kettles. Now, the issue there is China was exporting a lot of transportation fuels. So they have tightened that global transportation fuel at the market at the exact same time that we've seen the Russia and the other things. So they're part of the problem. They're not the solution. So they've helped out in crude. Again, I may go, crude oil is the noise. Products are the signal. And so when we think about their incentive to come back, the profit margins are just simply too large for any entity out there that has spare refining capacity. It's nearly the price of crude. So again, yeah, the crude price is off, but the distillate in the gasoline and those product prices are not off. Hence why when you look at the pump prices, they really haven't come down that much. In fact, when you look at the pump prices, the marketing margin, the refinery margins have never been this high. So the question is, will China respond to the economic incentive of record margins? The tea kettles are the ones that have that incentive.
Jeff, it's good to see you, buddy. Appreciate catching up.
Great.
Jeff Currie there. Thank you, sir, of Altis Partners, the latest on energy. To Jeff's point, the abundance illusion, when he breaks it down like that, it's hard to disagree. The problem you've got right now for many market participants, they're ignoring this because they were burnt. They listened so much back in March, April. The gains were elsewhere in chip stocks and all that stuff. And this is back in the front and center of the mind, I think, of a lot of people.
Also, I really like that Jeff brought up what's going on in Russia, because there has been this hyper focus on the Strait of Hormuz. Russia has banned diesel exports. They're seeing internally one of the worst fuel crises since the collapse of the Soviet Union. And they are a massive exporter. They are dealing with a serious problem right now. And the global market, to Jeff's point, has kind of just ignored it at the moment.
Can I quote crude? I feel like Jeff's going to jump through the screen.
I know, that was... he was like, what are you doing talking about oil, Annmarie? It's all about product.
Turn the volume down, Jeff. Brent crude, 86 this morning. Let's give you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Andy Burnham, officially the leader of the UK's Labour Party. He's set to become new Prime Minister on Monday. Speaking to the Labour conference, Burnham saying, quote, "This is a proud moment for which I'm ready." US regulators tracing a parasite outbreak to shredded iceberg lettuce served at Taco Bell restaurants in 6 states. The CDC is still investigating other cyclosporiasis illnesses that are unrelated to this outbreak. President Donald Trump's media company is offering to sell traders fast access to his social media posts. Trump, who frequently moves global markets with social media posts, has the biggest following on Truth Social with almost 13 million users. That's your Bloomberg brief. John.
Bonnie, thank you. Thanks for the update. Up next on the programme, funding the AI boom.
The hyperscalers are issuing so much IG corporate debt.
We used to talk about the debt diet, where companies kind of get restricted. We're not seeing that yet.
These hyperscalers were negligible players really in the IG space several years ago. They'll be up to 7 to 10% by the end of this year.
Up next, Dominique Toublan of Barclays from New York City. You're watching Bloomberg Surveillance. China in focus this morning. Equity futures sliding on the S&P 500. We're negative. We're down by 0.8. On the Nasdaq, we're down by 1.6. You see the chip stocks suffering through the week, suffering again this morning. The chip players on the week down by more than 8% through Thursday, coming into Friday. Down again this morning. Nvidia down by 2.5%. Hyperscalers, the big spenders, struggling as well. The question: are we spending too much in America, given the developments that we've just seen take place in China?
Can you justify it stateside, given what we have in this China shock, almost 2.0 DeepSeek moment, as people are drawing a parallel to a Kimi moment with the moonshot AI startup, and investors are saying this is cheaper, it's open source, and right now what we know is that people are saying this is going to rival the likes of Anthropic's top model, Fable, Mythos, OpenAI. And what does that mean for the models coming out of the United States that cost a lot more money?
The Nasdaq is down by 1.6%. Let's talk about the big spending under surveillance this morning, funding the AI boom.
The hyperscalers are issuing so much IG corporate debt.
Money is still very cheap for these AI hyperscalers.
We used to talk about the debt diet, where companies kind of get restricted. We're not seeing that yet.
These hyperscalers were negligible players really in the IG space several years ago. They'll be up to 7 to 10% by the end of this year.
So here's the latest this morning. Enthusiasm for tech debt showing signs of slowing. Demand for Amazon's $25 billion bond offering earlier this month underwhelming, with big tech still expected to tap the debt market again this year to fund massive AI spending. Dominique Toublan of Barclays downgrading the US high-grade tech sector to underway. He writes hyperscalers are nearing an inflection point in IG. The issuers are already widely owned, suggesting volatility is here to stay. Dominique joins us now for more. Dom, it's good to see you.
Good morning.
Thanks for coming into the programme. So SpaceX came to the market. The debt traded softer. Amazon came to market. We saw the secondary market trade softer once again.
Mm-hmm.
Can you walk us through what's been happening, these developments of just this last month?
Yeah, so what's been happening, if you look at until the last quarter, what we saw is this new hyperscalers that was very well received. And now the stats on the primary market is weaker. Not only are they getting more discounts when they issue, not new issue concessions, larger than the rest of the market, but also the subscription, how much people want in the primary is actually slowing down as well. The rest of the market is stable. And then the second aspect that you just mentioned, if you look at the performance a few days after it's been issued, if you look until the last quarter, they were performing well. It's not been the case now. And Amazon kind of surprised people a little bit. There was, you had to make space. And so what you saw is people making space using still the TMT sector, not so much outside, but there, to just make room for Amazon there.
It raises questions. How much capacity do we have to take down more supply later this year? And I think the better way to answer that question is how much capacity do we have at these spreads, at these yields, to take down additional supply later this year?
Look, investing in hyperscalers right now is like sitting down at a 3-star Michelin restaurant and you don't know how many courses are coming. And the food is going to be great, right?
There's always
but
three too
you have
many.
to pace yourself. So that's a very hard question to answer. But at some point, you think that if so much more is coming at a price that starts to be attractive, particularly for the rating, you're going to have to make space selling other stuff. So the key question is, when do you start to see this contagion, not only in the TMT sector that is really affected by the AI supply directly, but away from it?
OK, this is important. You think the risk might be elsewhere in IG, in other sectors, to make space for that debt that comes to market?
Correct. So it's not the fundamentals question. It's not like there's, the macro is fine, the credit fundamentals are okay, earnings have been good, the banks this week have been good. But the question at some point is, if too much supply is coming, you're going to put pressure on everything else, right? Historically, if a sector issues a ton, that sector underperforms versus the index. That's what we've seen in hyperscalers. Look, the 4 best hyperscalers, they rated AA. They're now trading wide to the rest of the index. They were trading 40, 50, 60 basis points tied to the index a year and a half ago.
Lisa, if she was here, she's not here today, but if she was around the table, she would be asking about the risk in IG relative to, say, high yield. Mm-hmm. It's peculiar that we're talking about this in investment grade and not in junk in high yield.
It's very new. So look, the way we looked at this, the hyperscaler are punching above their weight here, in the sense that they're about 4% of the index. The big six banks are about 8% of the index. But we like to look at risk in a different way in the bond market versus the equity market. So what is the spread risk, so default risk? What is the duration risk, sensitivity to rates? If you combine this, the hyperscalers, the six hyperscalers, are larger than the big six banks in the index. And that's happened, obviously, over the last year. So this is just skyrocketing really, really quickly to a big chunk of the risk in the index.
Things are moving fast. So we wake up this morning, we get these developments in China. And for those of you just tuning in, a new model out of China, the company says is equal to the capabilities of the models coming out of, say, Anthropic and OpenAI. And of course, with regards to China, we're thinking about they're able to achieve this and they're spending a fraction of what we spend here in America. Raises questions about whether these hyperscalers are spending too much money. Mm-hmm. What's your view on that at the moment?
It's very hard to predict, right? If you look a year, 2 years ago, I would have not predicted we would be here today with these models. And so what you try to look at is what's happened in the past. So first, if you look at technology, kind of innovation cycle like we have, never seen go that in a straight line. So I would expect some hiccups and volatility. And the second is, if we have a DeepSeek moment now, with the amount of debt we have today compared to a year and a half ago when DeepSeek happened, the impacts should be larger, right? There's more leverage in the system.
This is an important note. The DeepSeek moment happened, we moved on really quickly. This moment's different, the backdrop is different. How different is it? Just explain it if you can in a minute or so. How different 2026, the summer of 26 is for a DeepSeek type moment compared to, say, January 2025? How much has changed in 18 months?
It's just because the amount of CapEx that's being a program spent and the amount of debt that's being raised to finance this CapEx is now, going through the motions. We have probably hyperscalers issuing close to $300 billion this year. That's a big number. When we were at the DeepSeek moment at the time, there was not so much of that going on. This was new. And so now the question is, how do you get from spending money to the NVIDIAs of the world, to hyperscalers, and then to companies using this? Now a company can say, well, this model is cheaper than that model. For this question, I'm happy to use this one versus that one. Because right now, they're just adding costs, right? At some point, you cannot just keep on adding costs. So I think already now the first adopters are optimizing on what model they want to use for what questions. And that's likely to continue.
Dom, this was great. Appreciate it. Come back soon.
Thank you.
I imagine we'll have more supply later this year.
Definitely.
Thank you, sir. Dominique Toublan there of Barclays on the latest situation in the credit market. It's a different moment. 18 months later, you've got the hyperscaler spending now that's now shifted to the debt market. To Dom's point, raising far more capital than many people anticipated in both debt and equity over the last, let's say, 12 months. It's a different moment for leverage.
Yeah, and you have a China shock at this exact moment when clearly they're making these models much cheaper. How they make their models, we still have a lot of questions on. But I wonder if what's going on in China kind of means we're going to get cheaper models out of the United States. Do we see some sort of demand destruction in the United States that then brings the whole prices down?
Coming up next on the programme, we'll talk about some of these issues for the equity market. Binky Chadha at Deutsche Bank, Dan Ives of Yorkville Ives, and we'll catch up with the former Fed Governor Stephen Myron on the Fed, and Jason Draho of UBS here to react.
It's been an incredible first half of the year with respect to the equity capital markets.
It's not just one narrow group of companies and everything else is lackluster. It's really broad.
I think you want to be really thoughtful about the positioning that you have.
You want to avoid places that have not had good earnings momentum.
We think that this has legs.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. In your price section, the scores look like this. 90 minutes out from the opening bell, futures decline. We're down 0.8% on the S&P. On the Nasdaq, we're down by 1.6. The chip players hammered all week. Down on the week by more than 8%. Down again, taking some more weight out of a major rally year to date. Nvidia down by 2.4%. Intel down by more than 3%. The hyperscalers struggling a bit as well. The big spenders, are they spending too much? Amazon down by 1.3%. Microsoft off by 1.8%. Alphabet said to be behind on the development of a new Gemini model. That stock down again this morning by 1.5%. It's developments in China spooking this market once again.
Yeah, the latest source of anxiety is coming from Moonshot, this AI company in China, and their latest model called the Kimi model, Kimi K3, I believe it's called. They're basically saying that this is going to rival the best models out of the United States, and it's going to be a lot cheaper, and it's going to be open source. So another question coming into this market, are we spending too much in the United States when China is doing it, as you said, a fraction of a cost?
If they are indeed doing it at a fraction of the cost without having a little look at some of what's happening here in America.
And if they are indeed at the same level the mythos and the fable models are. We don't know all of these details yet, but this is where they're putting out, and which is why everyone is drawing these parallels to DeepSeek.
These are really important questions. We're getting some notes from various guests. Southside strategist, this from Jordan Rochester of Mizuho. Bigger picture, as we've seen with the mighty rise of China's car exports, it won't be long until US and European firms embrace cheaper Chinese model alternatives. He goes on to say it's a risk for Western firms that eventually could see a wave of AI protectionism creep in further down the road.
And then, of course, how hard is it to justify all the spend we are seeing into this trade, which is why the market is spooked. I push back a little bit on that because there will become a point where I think policy steps in and makes policy decisions on what you can and cannot use. They did it with U.S. models. There was export restrictions on Anthropic. Who thinks they're not going to do that when it comes to Chinese models?
18 months ago, was it? DeepSeek? January 2025, moved on pretty quickly.
Yep.
Can we move on again quickly this morning? I don't know, but the backdrop's changed. This was the point our last guest was making, that there's more leverage this time. Things have moved along in the last 18 months or so. The big spenders are spending a lot more, and they've turned to the bond market to borrow. They're raising capital in the equity market as well. The backdrop has moved in 18 months. It's not the same moment.
The context matters, and what he was talking about is like a Michelin star restaurant. You know it's going to be good, but at one point, is it just oversubscribed your stuff? And I believe you've done this before, and you walk out of the restaurant because you just
don't know
can't.
How many extra courses you're going to be getting?
Yeah.
He was talking about debt supply. Yeah. How much supply is going to be coming from these players later this year? Are they spending too much? I don't know. I really don't know. Equity futures this morning on the S&P 500 negative. We're down across the board. Underperformance on the Nasdaq. You can see that on the screen throughout this morning. Need to talk about crude as well. Brent and WTI pushing higher through most of this morning, up by around 2%. We've got Brent at about 86, WTI pushing 81. 6 days of strikes in the Middle East. Jeff Currie of Altis Partners this morning saying it's an abundance illusion. Don't look at the price of that. Look at the price of crude product right now. That's where the problems are.
Oil is the noise, product is the signal. I feel like he was jumping out of the screen. We were talking about Brent and WTI. He said, don't look at that. It all has to do with what's happening in gasoline, what's happening in diesel. And that cushion we've been living on, well, he says that's pretty much depleted right now. And at the same time, 6 days of strikes, and they're continuing this morning, and they are expanding. They are expanding to different assets when it comes to Iran. The bridges the IRGC relies upon and that they use, the United States is starting to target them as well.
Brent up 2%, 86 so far this morning. Coming up this hour, we'll catch up with Binky Chadha of Deutsche Bank on the road to 8K on the S&P 500. Dan Ives of Yorkville Ives with chip stocks on the brink of a bear market. And we'll catch up with the former Fed governor, Stephen Murren, on why the Fed could be looking at the wrong signals. We begin this hour with stocks pushing lower and chips selling off on deepening AI anxiety out of China. Binky Chadha at Deutsche Bank staying bullish, writing extremely positive Q2 corporate guidance has driven consensus S&P 500 earnings growth expectations to more than 26%. We see macro and tech momentum helping earnings clear the high Q2 bar. Binky joins us now for more. Binky, good morning.
Good morning.
You wrote that at the end of June, I believe.
Yes.
Have things changed in the past few weeks?
I would say from an earnings perspective, they've gotten better. We've had, as of last night, 44 companies report. I noticed during the week you've been talking a lot about, you don't want to miss in this market. Well, I can report a rather remarkable fact. We have 44 companies in the S&P 500 that have reported, and not one has missed on earnings. Now, you can take all the derivatives of earnings and guidance, and
Sure.
maybe it's not all.
IBM might be a factor in that, of course.
But as far as the numbers are concerned, nobody's missed, and that's absolutely that's very, very, very unusual, is the way I would put it.
What's the signal
Typically
you would take from how the market's responding to it? Netflix this morning being punished as well.
Sure.
People might call that a miss, Binky.
So the price action you might call that a miss, but I would say the actual numbers, there's no miss so far. We were not really looking for too much from the market during the earnings season. I mean, I would just, remind that earnings seasons are generally positive, basically, for the equity market. Equity market's up 75 to 80% of the time, but it's up by an average 2%, and that's kind of what we were looking for. Our framework for thinking about basically, how much is the market going to move up in a typically positive period is based on really what the market's done going into earnings season and where positioning is, and both of those things basically argued for looking for an average 2%. Now, 2%, would take you from the eve of earnings season, would take you just to 76.50. So, bigger picture, S&P's been in a range 6-7 weeks now. June 4th, 5th was the high. And I think, we're in a range, partly because of the need from a positioning point of view for a rotation in investor positioning, and that's kind of what's happening.
Well, let's start
it's a mini version of October. Sorry,
because
please.
you put out a note in the last week on positioning, and it's important. Bank of America have put this out, their fund manager survey earlier this week, and their note was summer upside for risk assets is limited because of bull positioning. What's the path to 8K right now?
So I think, the easiest path to 8K is, a range-bound period. We've got earnings in terms of the numbers growing at, the consensus says 26%. We say 29%. If you take the beats so far seriously, we're talking about earnings growth in the 30s. And I'm not talking about a tech company. I'm talking about the S&P 500 as a whole. Valuations are going to get cheaper. And so the market's going to go up unless, some big tail risk is realized. So a summer pause is not really unreasonable. There is the uncertainty, about the midterm elections. And what I would say is, just in terms of thinking about 8K, just remember that midterm election years, Q4, so starting a month before the midterm elections through the year end, 21 of the last 23 midterm election years have been positive returns, so the risk reward is positive, and the average return is 7%. The caveat, of course, is that in those two cases when we didn't go up, one was under Trump 1.0 midterm election years. So, but I would say, it's a reasonable baseline view. And of course, 7% from the recent high would take you higher than 8,000. So,
do you think that's also been a pause for the AI trade? Because what we're seeing the likes out of the New York governor putting a moratorium on data centers, policy after this midterm election may directly affect this trade in financial markets?
It might, but I would argue, right now, all this is a positioning story. It's got a little bit to do with fundamentals. If you just think back to the last big rotation that we had from, the October highs in the NASDAQ, basically through the Iran war, you have tech basically continuously underperforming, actually falling, and the market's going perfectly sideways, where they have this huge rotation. And then we have this very, very quick recovery. It is the very, very quick recovery, basically, that is creating many of the issues that you see right now, which is positioning is long in tech, positioning is trying to pull back, but there are huge inflows into tech. It would seem that the end investor is buying the dip in terms of flows, but flows have been strong for a long time. So, you're starting to get into the decimal points of the weekly flows to make that argument.
When I look at the price action in chips, most people would agree with you. This is about price and positioning. The response to earnings tells you a lot about price and positioning. I do want to talk about fundamentals, though. The developments in China could be a fundamental issue. Could raise questions, fundamental questions, about whether the spending that has driven these gains is justified or not. What's your response to that this morning?
So, I think that at the end of the day, so we are sort of in this new technology world, and what it's going to deliver is a spectrum of things, is the way I think about it, rather than a binary outcome of who's going to win. you need, I mean, it's obvious to make the point that you need the more sophisticated models to answer the more difficult questions. So there's going to be a spectrum. There's obviously a race to win the platform that, and that's, it's pretty normal, is the way I would put it. But yes, I mean, is it a fundamental risk? Yeah, I mean, competition always is.
Binky, it's good to see you.
Good to see you.
Appreciate it. The path to 8,000 on the S&P 500. Binky Chadha at Deutsche Bank on the stunning earnings we've seen in this country. Pretty phenomenal. Equity futures this morning declining by around 1% on the S&P. On the Nasdaq, you can see it down by close to 2 percentage points this morning. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. President Donald Trump using a roughly 25-minute primetime address to revive claims that the 2020 election was stolen.
Over a period of years, starting during the 2020 election cycle, the People's Republic of China carried out what is believed to be the largest compromise of election data in history, resulting in China's illicit acquisition of 220 million U.S. voter files.
Trump also accusing U.S. government officials of trying to cover up Chinese interference. PayPal's board says the Stripe Advent takeover offer is inadequate. Reuters reporting PayPal thinks the offer undervalues the company and would face regulatory and financing hurdles. PayPal hasn't formally responded to the proposal. New York City Mayor Zohran Mamdani declining a pay increase. The City Council voting in favor of an 18% rise for the city's elected officials, their first pay bump in a decade. Mamdani's salary would have jumped to more than $306,000 a year, but he turned the raise down. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. Up next on the programme, we'll get you some morning calls. Plus, we'll catch up with Dan Ives of Yorkville Ives, with chip stocks nearing bear market territory. Very close on the brink of it, as of the close yesterday, about to cross it, based on the price action so far this morning. Live from New York City this morning, good morning.
The semiconductor trade has been a volatile one. The equity trade through just a week or so ago was heavily momentum driven. The likes of Alphabet, OpenAI, Grok, and others, they are playing the long game. So I suspect that they're not huddling up this morning, altering their CapEx estimates for the coming months.
That was Aaron Kennon of Clear Harbor Asset Management on the tech route, if we can call it that, this morning. We're down across the board. Equity futures on the S&P down by 0.9. Down by 1.9 on the Nasdaq 100. A new development from Moonshot, a new model, Kimi K3, raising lots of questions about whether we're spending too much money in America, lots of questions about the capabilities of this new model, whether it truly equals the capabilities of the models coming out of Anthropic and OpenAI. But that's sparking the sell-off, reminiscent of what we saw, let's say, 18 months ago, back in January 2025. DeepSeek, is this DeepSeek Volume 2? Things were already pretty jittery for the chips trade. Chips are down across the board so far this morning. The chip players are really struggling. Nvidia down by close to 3%. Intel off by 4%. AMD off by close to 4% as well. As of yesterday, these chips from the highs of June in just 3 to 4 weeks down by close to 20%. And I get it. Already getting the feedback from subscribers this morning. Can you really call it a bear market when we rallied 90% in Q2 and we're still up on the year by close to 70? I get it. You probably can't call it a bear market. People will talk about getting close to bear market territory, but it's quite the correction off the highs of only a few weeks ago.
And the latest anxiety, as you mentioned, coming from China. But really this week you could have picked your poison, and the bar for these companies is set so high. And this moonshot Kimi K version is basically questioning whether or not the hundreds of billions of dollars we're spending in AI happening in the United States is needed. Of course there's going to be tons of money spent, but is it that threshold going to be needed if China is being factual and honest on what they were able to produce and put out?
If it's truly export compliant. Amazon, a big spenders down across the board as well. They're spending too much money. Amazon down, Microsoft, Alphabet. Alphabet's a struggle too. Got to talk about the backdrop. We keep talking about the context. The news from Alphabet yesterday that the Gemini model was slightly behind. It's like the 1-2 punch to sentiment from China and from the United States.
Right, Gemini behind now, where they were supposed to be when it comes to the likes of OpenAI and some of these other models. Why are they so behind? Can they catch up? We've seen this a lot with these models, though. Each company, remember when they all have their own code red moment, then they catch up?
Alphabet left for dead and then flying high, and then in the last 24 hours, I'm with you, Annmarie. Touch grass, Jim Zelter of Apollo. I was reminded of that quote moments ago. Just touch grass, enjoy the weekend, watch the World Cup. We've got to talk about the risk here. The Nasdaq is down by close to 2%. That's the price action. Let's get you some morning calls. First up, Barclays raising its price target on TSMC, expecting AI demand to continue to rise. Your second call from JP Morgan cutting its price target on Netflix, citing questions on the company's subscriber growth. And finally, HSBC upgrading Apple to buy, saying it's at an operational turning point with the AI boost coming at the right moment. They are not a big spender. That stock on a relative basis has been outperforming. Let's stay with tech. The global sell-off in chip makers accelerating with a new AI model in China sparking fears of another DeepSeek moment. Dan Ives, in a brand new role as partner and senior managing director at Yorkville Ives, writes tech stocks are laser focused on seeing the monetization trend for AI in the second quarter. Hyperscalers will be the standouts and remain foundational to the broader tech spending trends. Dan joins us now for more. Dan, good morning.
Great to be here.
New firm, let's start there for the benefit of our audience. New position, what kind of seat are you speaking from?
Yeah, so again, partner and really be, on a research perspective, that's going to be my main role at Yorkville Ives. But it's a modern merchant bank. I mean, this is something, for me, 25 plus years on Wall Street, it's the evolution, it's the next step. It's something to really build something that I think is going to be special in this market, but really focused in terms of sectors, AI, tech, infrastructure, energy, because where I view the fourth industrial revolution, so excited to do this and found just the best partners to do it with.
These companies are borrowing a lot of money. They're spending a lot of money. The questions we're asking this morning, based on developments out of China, is whether they're borrowing too much and spending too much. What's your reaction to what we've heard from China?
I think this is just called a white knuckle moment, no different than a mini DeepSeek moment to some extent. The reality is, look, models, you're going to have 10x more models over the next 5-7 years, vertical, geographic. The reality is that it's Anthropic and OpenAI's world, and everyone else paying rent relative to the models. Gemini clearly narrowing the gap. China, you're going to continue to see, very good models come out of there. But it's my view, when you talk about broader spending, the trillions of dollars spent that you're going to see in AI, it's less about the models. It's about the data. It's about ultimately the build out. And I think that is something that will get validated 2Q earnings.
But doesn't this show that China is not that behind the United States? They're neck and neck when it comes to AI development?
I think for the first time in 30 years, it's not even a question that U.S. is ahead of China when it comes to tech. Now, when it comes to models, in terms of the more of a commoditization, open source, and the way that they're going after it, are they ahead when it comes to robotics, when it comes to energy? Yeah. But there's one chip in the world fueling the AI revolution, godfather of AI, Jensen, NVIDIA. And I think what you see from hyperscalers, what you see from OpenAI and Anthropic, this is going to be an arms race. But I don't even think there's a question where the U.S. is relative to China. When these moments happen, you'll see jitters, white knuckles, stocks will sell off.
Why is China able to do it cheaper?
Because at the end of the day, the open source model, if you look, whether it's DeepSeek or any others, when you compare it to what Anthropic's doing, to what OpenAI is doing, that's tip of the sphere. In other words, OpenAI and Anthropic, they're going after the enterprise market. The models are just really the start of what the broader sort of end-to-end framework is going to be. When you think about where the vast majority of spending is going to be in AI, it's not necessarily in the models, it's in the data center build-outs, the CapEx, what ultimately is going to be physical AI. I just continue to view commoditization will continue to happen on the models. I don't get as sort of nervous when moments like this happen.
There's the spending phase. Can we talk about the end phase? And I know this is really difficult to do. Where do you think the money's ultimately going to be made? The application layer, the infrastructure layer? Where do you think the money will be made?
I think it's the application infrastructure layer that's going to really be the hearts and lungs. Because if you think about today, all the data centers getting built, those data centers it'll be like a factory for cars. You build out the factory, but now you actually need the lines. What's the operation? when you look at as more and more companies on the use cases, that's enterprise, that's software, that's use cases.
Are you confident the app layer won't become commoditized?
I would tell you the more and more companies that I talk to that are deploying AI and going down the AI path, I feel that that's become less and less of a risk. There'll be winners and losers. There'll be ones where ultimately they're on the wrong side of it, and maybe some of those stocks are reflecting some of the nervousness. But the view today is that, look, we're still in the third inning of the AI revolution. Now, we start off, we're in the second inning. This is not seventh, eighth inning because of where this is all going in terms of physical AI. Look what Apple's doing. That's just starting the consumer AI revolution, where they're essentially a toll booth in the AI highway.
What's going on with Alphabet and Gemini? Why are they behind?
I view that in terms of everything that they're doing, they'll be behind at points. But the reality is that their end-to-end framework, from cloud to Gemini to what's happened on search, they could catch up pretty quickly. And I just think they've narrowed the gap much more than anyone would have thought. And it goes back to a year ago, New York City cab drivers bearish on Alphabet. Look where they are today. And maybe,
where are they today?
I'd say New York City cab drivers still bearish. Maybe they're bearish on Microsoft versus where,
I think you've got to come up with a new phrase, because in my experience with my New York City cab drivers, they're better on this market than most people I speak to on a daily basis.
And that's very healthy because of ultimately more and more retail.
They've been long and strong.
They have a big seat at the table. And I know New York City cab drivers, now they're driving Bentleys because of this market.
Right, they'll be saying, I remember years ago, they'd be like, I really like Tesla. I'd be like, what, this multiple? That's crazy. And then Tesla just like to the moon, up and to the right.
And that's why a lot of them are driving Bentleys today.
Right. Yeah.
Or
True.
Cybertrucks.
Or Cybertruck.
Many of them don't know where they're going anymore, which is its own problem.
That's a problem.
Did you notice that they hand you the phone now?
No,
to like,
I had an
put the
experience
address in
recently
for
which
the
is even
GPS.
worse. A taxi driver took my phone and said, do you mind if I keep it up here? And I just thought he needed it for 5 minutes. I was like, I need it back. I have calls coming in. He's like, I need it for the whole ride.
And then there's times you're like, why are you taking the Holland Tunnel? You should be taking the Wolfe. And then you have to actually start to, I know.
They don't know where they're going.
It's an issue.
I know. Dan, it's good to see you.
Great.
Thank you, sir. No dress code at Yorkville?
We're gonna be dressing more and more color at Yorkville Ives.
Do they know that?
They do know that, and I think this is all a process for some of them.
Oh, interesting.
Quite a process. All right. Best of luck. Dan,
Great,
thank you.
thanks.
It's good to see you. Who's going to win on Sunday?
I think it's messy.
Yeah, gets it done. All right. Dan Ives of Yorkville Ives on this tech sector, and a bit of a rout emerging going into the weekend in the equity market. Up next on the programme, we'll catch up with the former Fed Governor Stephen Miron and why the Fed should rethink the focus and look back on money supply. So we're 60 minutes out from the open about. Equities declining here on the S&P. We're down by, let's call it 0.9%. On the Nasdaq 100, let's call it down 2%. The risk has been building in the chips trade for quite a while. It was up and to the right, almost vertical through Q2, up almost 90%, something like that. The biggest quarterly move we've ever seen for some of these chip names. And then things started to unravel. And it's all about price and positioning for a lot of the time. So we're down by close to 20% since the highs of the end of June. You saw some fantastic earnings. We didn't respond to it positively. That reinforces and validates the view that a lot of this was about price and positioning. Then we got some fundamental news out of China overnight, potentially fundamental news, a turn, that you're able to achieve the same technological progress, perhaps without spending as much money. It raises questions for the big spenders, the hyperscalers. It raises questions for the big beneficiaries of that spending, which are the chip players, and the chips down again this morning.
And then Dan Ives comes on and says, well, this is all bogus. There's going to be moments like this. It's like DeepSeek. It's going to fade into the background shortly and very soon. But obviously, this just exacerbates some of the questions the market already had this week in terms of the hundreds of billions of dollars being spent on this trade. And is someone able to do it easier, quicker, and cheaper?
Are we spending too much money? We'll get into that in just a moment. Let's turn to the bond market. So a bit of risk aversion. You'll see yields are down across the curve. On twos, we're down again, have been down throughout most of this week off the back of softer CPI and softer PPI, potentially removing the urgency to hike rates anytime soon. That weighs on the 2-year. What's interesting about this decline in yield so far this morning is that it's happening against the backdrop of higher crude prices. So we're kind of ignoring what's happening on the inflationary side of things with regards to energy, and we'll spend more time on that in just a moment. But Brent and WTI higher, given what we're seeing in the Middle East.
Right, and potentially it's going to get a lot worse when it comes to the Middle East in terms of we are at the 6th consecutive evening as of last night of strikes. It bled into the morning as well. And as we've been talking about the entire morning, they have been expanding than just the normal targets for U.S. forces. They are now going after critical infrastructure that the IRGC is reliant on to then go after commercial shipping in the Strait of Hormuz. On top of that, we've seen the U.S. blockade come back. And it's not just for show. It's been very aggressive, according to what we're hearing from CENTCOM, and how they are turning ships away and even having to board one ship.
That's the setup this morning for the price action. Let's talk about the setup for the Federal Reserve with this in mind. A trio of Fed officials sounding the alarm on stubborn inflation, keeping potential rate hikes firmly on the table. Mike McKee has more. Good morning, Mike.
Good morning, John. Yes, I think what we're looking at here is a division at the Fed. The people who want to raise rates very early on because inflation has been going up and we've got this war danger of more are a smaller group now because we've gotten lower PPI and lower CPI. But there is a substantial group of people who think that we've just had enough. We've been too high for too long and we need to do something about that. And you saw that last night with a number of Fed speakers, including Lori Logan and including Jeff Schmidt, Philip Jefferson, sort of in that camp, the vice chair, saying that if we don't see movement, I'm prepared to move, which is what Lisa Cook said the other day. So you've got a lot of people who are keeping the idea of rate increases on the table, which is why you still have one priced in between now and the end of the year. And as Annmarie said, we've got some dangers out there in terms of future numbers. We just got the import price index. Take out petroleum, and it's still up 0.5%. And on a year-over-year basis, it's up 7.1%, was up 6.6% last week. So we still have an inflation issue coming into the country from tariffs that haven't even hit yet. So there's going to be a lot for them to discuss over the next couple of weeks.
Mike McKee with the latest on the Fed speak. Mike, thank you, sir. Enjoy Idaho. Not dressed like a park ranger this morning. You noticed that? Different shirt from McKee.
Well, I did send him some messages.
Did you?
Appropriate attire for television.
McKee on tour at the moment, having a good time. OK, let's talk about the Fed. Recent Fed governor and White House economic advisor Stephen Myron, now a senior strategist at Hudson Bay Capital, arguing policymakers should pay less attention to backward-looking data and potentially more attention to the money supply. He writes, Federal Reserve officials often claim to look at everything. Ironically, in recent years, their data set has excluded measures of monetary growth. Stephen joins us now for more. Steve, it's good to see you, sir.
Morning. Thanks for having me back.
Hey, welcome back to the programme. I read the note that you and the team put out. Fantastic read. And I want to say up front before we start this conversation, because I think some economists listening to this will say, oh, not money supply. Here we go. You say in this note, this report that you've put out, that you're not suggesting we should target monetary supply again, that you think there's information that's worth looking at in money supply. So let's start here. This is something we used to do at the Federal Reserve. You had the quantum of money and the velocity of money. Yeah. And because the velocity of money was largely considered to be stable, we could focus on money supply. That changed, and then people stopped focusing on supply. So let's start there. Why we used to look at it, why we stopped, and why you think it's worth looking at again.
Sure. So there's, as you point out, there's this school of economics called monetarism, heavily associated with Milton Friedman, who was a mentor for Kevin Warsh and someone who Chairman Warsh invokes frequently. And monetarism is basically the notion that the money supply determines growth in, or leads to or predicts growth in nominal GDP and in real output and in the price level. And so therefore, by controlling the money supply growth, you can control the growth of nominal GDP. And if inflation seems too high, you can put a damper on money growth and it'll come down. Now, as you point out, that stopped being useful in the 80s and 90s because this velocity of money that enters into the equation, what economists call money demand, started to move around and be volatile. And so if money demand is moving around at the same time as money supply, then you can sort of see on any supply and demand chart, the equilibrium point is going to be jumping around. And so changes in the money supply no longer serve to be useful in predicting changes in inflation and changes in growth. Now, what we did is we looked at, a number of things that Chairman Warsh has written and said over the last 10, 15 years, and found that he repeatedly focuses on this as a useful input into predicting inflation, into predicting growth, right? This is not to say we're going back to targeting money growth, but just that it contains information, that information shouldn't be thrown out. And what we did was to sort of survey the literature. There's been an active frontier of research in this in the last 10 years or so, what I would describe as rescuing monetarism. And the way that it rescues it is to say, hey, this stuff still works. It's just that you weren't measuring money correctly. And the reason why velocity started whipping around is because of financial innovation. When you introduce new forms of money, sometimes it's used as a store of value and not for transactions. And if a money market fund is used as a store of value and not for transactions, then an increase in money supply driven by an increase in a money market fund isn't going to predict GDP growth. And so what these new forms of measuring money do is they basically weight the different types of money based on how money-like they are, in the same way that a price index will weight housing more than video games because you spend more on housing than on video games. And when you do that, the whole theory actually becomes quite usable again and serve to predict well the disinflationary pressure after the GFC, which again, people rake these models over the coals because M2 was exploding, and yet we were in a deflationary, poor growth environment. Yep. And there were all these, hysterical letters and op-eds about exploding money supply was going to lead to hyperinflation. It didn't materialize, and it was egg on the face for monetarists. But it turns out that if you measure money correctly, you actually would have gotten the post-GFC environment correctly. You would have gotten the post-COVID environment correct too.
Let's pick up on that, the post-COVID environment, because money did explode. Money supply did explode, rather like what we saw after GFC, but there was a different outcome. Can you just explain why the outcome was different and why it was still useful to look at supply?
So the money supply exploded after the pandemic as a result of stimulative monetary and fiscal policy, right? There was a combination of rates being at zero for a long period of time, record levels of QE, of Fed balance sheet expansion, and also fiscal expansions, fiscally driven expansions of the money supply. Now, one nice thing about monetarism is it actually doesn't really care what the origin of the expansion of the money supply is. The origin of the expansion could be monetary, it could be a fiscally driven expansion of the money supply, or it could be foreign. You could have a situation in which there's pools of savings abroad that then come and get spent, and that results in increasing money supply. All it tells you is that there's a link between a change in the money supply and outcomes in the economy and outcomes in the price level. And so therefore, these models did a really good job after the pandemic predicting that inflation would be high and predicting that inflation would be persistent. And when you have that type of situation, it leads you to think, hey, you shouldn't look through supply chain shocks. You shouldn't look through negative supply shocks, and you need to start getting policy into a right place for the inflation mandate. Right now, you don't see that at all. You see the model saying that money growth is approximately neutral.
If money was part of the Fed calculus, then would they have risen rates sooner?
I believe so. And I think it's not just rates. I think it was balance sheet stuff, too. I mean, the Fed, after the pandemic, the Fed was buying mortgages even when home prices were up 20% year over year, right? Home prices are up 20% year over year, and the Fed is still buying mortgages. They're saying more credit into the housing sector. And because of the way that the inflation statistics are calculated, and again, inflation measurement is an area I spend a lot of time thinking about. The way that we measure housing inflation really filters into the data for years, right? Measured shelter inflation right now is running closer to 3%. Market rents have been running at 1% for about 3 years now. And so as a result, it takes a really, really long time for shelter inflation to sort of for changes in rental markets to pass through completely through the measured inflation data. Measured inflation data today are still closer to 2023, 24 than they are at present. And so as a result, if you're buying mortgages when home prices are already up 20% year over year, it's very obvious that it's going to be persistent inflation. So I do think that looking at this would have been helpful earlier. I think that looking at it is helpful now. And the fact that these things are neutral now tells you the supply shocks that have been elevating inflation recently are a lot less likely to be persistent than they were in 2021, which tells you the orthodox policy response to a supply shock of looking through it is probably right.
You've sat on this committee. How difficult will it be to convince the rest of the committee to look at the same things?
So some of them are there in terms of thinking about the supply shocks like that. So if you look at what New York Fed President Williams said a couple days ago, I think it was a couple days ago, he said monetary policy has to be forward-looking, right, which is something that Chairman Warsh has also said. The reason you say that is because there are lags with which monetary policy hits the economy. It doesn't hit the economy for 12 to 18 months. To take this back to Milton Friedman again, he had this parable of the fool in the shower. You know, you turn the water temperature in the shower, it takes a minute for the water to get hot, stays cold, you turn it even hotter, and then it finally comes out scalding. And so then you turn it down, but it's still scalding, so you turn it all even more down, and then it comes out freezing, and so you never get it right? That's because there are lags with which you change the temperature in the shower and it hits water. Monetary policy is the same.
Long and variable.
Long and variable. And President Williams said this, and I think it's correct. Now, there's another approach, which means you need to focus on where inflation is going to be 12 to 18 months.
Can I ask you, though, your opinion, how long and variable you actually think they are, given the wealth channel now, how quickly we price this story in financial markets? Has that changed?
I think that there's some evidence. So when we surveyed this literature on monetary policy, on monetarism that we covered in the paper, one of the papers that really set off the reinvigoration of research into monetarism through these Divisia aggregates actually found that monetary policy lags had lengthened recently, which was surprising to me. So I'm still inclined to go with the consensus of 12 to 18 months. I'm not inclined to change. There's another approach, though, which I think you sort of see from other members of the committee, who basically say something like inflation has been high recently, and therefore I expect it to be high in the future. That, to me, is, treating monetary policy like it's momentum trading. I think that's not, for me, that's not enough. I would want to be forward-looking. I worry that some of these people are basically buying inflation at the top.
Steve, I haven't seen you since you left the Fed. And
Lucky you.
I was wondering if you could just give us some insight. What was it like in terms of going from the White House to the Fed? You had a very close relationship with the president at the White House. Did he call you when you were at the Fed? Do you still have an ongoing dialogue with him?
I haven't really spoken to the president since I left government. I stopped into the White House to resign, and that was a of course a great experience. I spoke to him when I resigned from CEA as well. I stopped into the White House then, and then I spoke to him a little bit about the chairmanship selection. But I wouldn't say that I had
Did he call for advice on who should be the Fed chair?
Well, I shared some of my views about what qualities that I thought were important in a chairman, and I wanted to be helpful in sharing those views. Yeah.
Did you give a specific name?
No, I focused on qualities that I thought were important.
And what were those qualities?
Well, I think, as I said moments ago, I think forward-looking behavior is important. I think a willingness to think deeply and carefully about the data and what they actually say is important.
Did you feel like that needed to come from outside of the Fed, that there needed to be a fresh start?
Not necessarily. I think I was, in my view, the important qualities in a Fed chairman are to think carefully about what the data say and to be forward-looking and to be flexible of mind enough to sort of say, this works, it doesn't work. In my mind, models are, there's a bunch of different economic models you can use for forecasting and for making monetary policy. They're kind of like jackets. You need to pull out the right jacket for the weather. You don't wear a down parka in July, right? And so it's important to understand that the models aren't universally true in all times and places.
This one wears sweaters in the summer.
It's cold.
Well, in here it's a little chilly, but it's not,
out.
But
I sometimes wear them outside too.
Steve, can we finish on this?
Yeah.
Listening to you, some people will find it controversial that you spoke to the president whilst you were sat on the Fed board. What would you say back to that?
I would say that I think that it's important to hear all views on monetary policy. I actually didn't even really discuss monetary policy with him. But even then, the president has not been reticent to share his views on monetary policy. He shares them with the entire world all the time, right? So, it wouldn't. I don't think I would. I don't think I would have possibly learned anything that everyone else doesn't know. Also, and I'm sure that if you interview him, he'll tell you on TV. Very quickly.
I have no doubt he'll tell us where he thinks rates should be.
Yeah.
Lower.
Right.
That's how he's always felt since the 80s.
Steve, it's good to see you. Thank you, sir. Appreciate it. Interesting report. Something we should pay attention to. If indeed it's something the Fed chair is looking at as well. The former Fed Governor, Stephen Myron, there on the latest with this institution. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. The US completing a sixth straight day of strikes on Iran. The Associated Press reporting that bridges were among the assets targeted. Iranian state media saying 3 civilians were killed. SpaceX aborting the latest test launch of its Starship rocket. CEO Elon Musk saying some of the rocket's Raptor engines didn't fire, triggering an automatic slowdown. He says the next attempt will probably happen early next week, with 2 of the engines to be replaced. A White House teleprompter operator is facing a federal investigation. The suspect is believed to have profited from wagers on the prediction market Kalshi over the mentions of words and phrases from President Trump's speeches. Kalshi said it froze more than $90,000 in profits. That is your Bloomberg Brief. John.
Evony, thank you. Appreciate it. Up next, Jason Draho of UBS saying market fundamentals should get the rally back on track. That conversation up next.
Valuations are going to get cheaper, and so the market's going to go up unless, some big tail risk is realized. So a summer pause is not really unreasonable. You have tech basically continuously underperforming, actually falling, and the market's going perfectly sideways.
Not this morning, it's not. It's going perfectly south. That was Binky Chadha of Deutsche Bank, just down on the S&P 500 by around 1%, on the Nasdaq down by close to 2%. The cash open about 40 minutes away. As we count you down to the opening bell, here's the trading diary for the week ahead at 10 a.m. Eastern Time. UMich consumer sentiment. On Sunday, it's the main event for the next week. It's the World Cup final. On Tuesday, Alphabet and Tesla earnings. Thursday, an ECB rate decision and another round of jobless claims. Let's look at the equity markets. Stocks pulling back with tech selling off into the cash open. Jason Draho of UBS writing strong fundamentals should support a continuation of the rally, but we recommend diversifying across equities. Jason joins us now for more. Jason, good morning. Good to see you.
Good to be here.
We've talked a lot this morning about the pain in tech. Haven't talked too much about the all-time high and the equal weight. What are you suggesting people do at this moment?
Well, diversify across equities, right? We've been saying this for a few months. The tech sector, let's call it tech plus, has done incredibly well this year. We've seen other parts of the market lag. It's been subtly beneath the surface sort of rotation where you've seen equal weight start to outperform, since mid-May. Small caps have outperformed this year. What we're kind of leaning into is more of a cyclical bias. So some of our preferred sectors, financials, industrials, consumer discretionary on the back of sort of a consumer strength.
It has all felt like one trade at some time. In the last month or so, it's really felt like that. Chips are cratering now. And if you're in this market, you're trying to work out, can this equity market do okay if that part of the market is performing so poorly? What's your response?
So if we go back the past year and a half, and you've seen the rotations in the market, like after the DeepSeek moment, you had semiconductors, software rallied. So you've seen a lot of rotations. The momentum factor, we had sort of this, it's kind of the crash in the momentum factor at the end of June, early July. If you actually track it and look at what was the trade, in some sense it was long semis, short software. It's an under one. So the surface of equity markets have been relatively calm. I mean, the market's been in a pretty range bound for a couple of months, but beneath the surface has been a lot of churn. But I think that's the churn is within, the kind of the tech AI related. The other line, sort of other parts of the market have actually been doing relatively well. I think reflective of the fact that the macro conditions are pretty supportive.
You mentioned DeepSeek.
Yeah.
Do you believe this is DeepSeek Volume 2? Is it different somehow?
I think there'll be DeepSeek 1, 2, 3, 4, 5, 6 for the
just
next
waves of this.
Just different waves, and the markets will have to digest it. At some point, there'll be probably a significant DeepSeek X number, whatever it is, that really is cause a bigger moment. But I think this is the reality of what we're dealing with at the moment.
What happens when we get to that DeepSeek that might be real? In terms of market reaction?
So I think the biggest thing, the markets are constantly worried about the capex spend, the return on investment. So at some point you'll get a question like, well, you're going to get the return, and is that going to dial back on the capex? You're already seeing the hyperscalers kind of in some sense underperform the markets. It wouldn't necessarily be a bad thing if you saw some capital restraint. You might actually think the market say, this is good, we're finally getting some sort of discipline. But the process of doing that could still lead to certainly turbulence in the market, rotations, and probably some sort of pullback. But I think that ultimately would sort of be a healthy thing if the markets believe the spend was sort of justified by the returns later on.
Do you think this is purely questions about the AI spend, or is it other macro factors as well, like the Fed weighing whether or not they're going to hike rates, or the conflict that's going on in the region?
So I look at aspects of the equity markets. Intra-equity S&P 500, pairwise correlation, the lowest it's been in 5 years. Dispersion is very high. You have this momentum factor that looks like it's an intra-tech trade. That to me tells the markets are not being driven by macro factors right now. Certainly not the situation in the Middle East or oil. It's being driven by questions about the tech trade. So if that's the case, the macro conditions, that in some sense, whether you believe it or not, the base of the market saying macro is benign. It's fine. Fed, maybe they hike, maybe they don't, but it's not a big drag on the markets.
Backdrop's okay. The threat of imminent rate hikes, got some cold water earlier this week. That's good too. But I think we're learning something about how this market responds to the incoming earnings. Earnings have been tremendous. Reaction to them hasn't been great. You can pick out a couple of names. I think Goldman, BNY, really nice earnings in the bank sector. Bank stocks responded to that. But for the tech trade, ASML, Taiwan Semi, Samsung, just getting the accumulation of data points over the last week, that even though earnings are great, this market's not rewarding them. On the tech sector specifically, what does that tell you about the next few weeks?
Well, I think part of it is stepping back, think about where we've gone in the last 3 months of how much the semiconductors have done, right? So there could be some element of buy the rumor, sell the news aspect where the market's rallied into it. Earnings expectations weren't cut going into earnings season. They actually kind of went higher. So it's not necessarily surprising when the bar is relatively high. You have to have not just really, really good numbers, but spectacular blowout numbers to move the markets. I think I'd look less day to day, but more sort of big picture. The trend has certainly been higher. If we get some period of consolidation and a sort of relatively quiet summer Friday, then that doesn't surprise me entirely.
It's hard to call it a bear market in chips when the chip index is still up 70% year to date.
Exactly.
After a 90% move in Q2, which is just crazy. Who knows what it turns into? Spain or Argentina? Last question.
Argentina.
Okay.
They're the New York Knicks of FIFA right now.
Yeah, feels that way. Jason Draho there of UBS.
They were at that last game. They came out, what was that, 83rd, 85th minute? I just hear my dad screaming, and I was like, oh gosh, someone just scored. Let me go see this.
You could just feel it was coming. It was like wave after wave of attack. And once they had the substitutions, and then once England retrenched and just sat there trying to suck up that pressure.
And once Messi made that face, you know,
what are
that
you
was
doing?
it. It was over. I'm actually looking at tickets right now on Ticketmaster. 8 handle for bleacher seats.
The get-in price now is $8,000.
That's what I'm seeing. Yesterday I saw 7 on StubHub.
Can you
Today
imagine $8,000 to sit up there, which is really, really high, with the air quality right now in New York, which is absolutely abysmal, incredibly low.
Well,
Imagine what that's going to feel like.
That's why I was hoping ticket sales would actually drop, because people don't want to go if the air quality is so poor.
I think they're still going to go.
Yeah.
Right,
I'm looking
we know
at
that.
literally the last seat in the house, and it is one of them $9,000.
That's crazy.
Section 336, row
Imagine
26.
those die-hard
Yikes.
fans. I know. Seriously. OK, who's your team?
I'm going
Argentina.
Messi, of
Okay.
course.
All right, OK. Not picking anyone. Coming up on Monday, we'll catch up with Laurie Calvasina of RBC, Kay Hurt of JP Morgan Asset Management, Peter Cheer of Academy, and Ozan Tamat of Deutsche Bank from New York City. Have a wonderful weekend. Stay safe. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.